Banks' capital adequacy and its roles as a risk management tool in the banking sector. The Solomon Fadun, Risk Management of Everything channel, presents Banks' capital adequacy and its roles as a risk management tool in the banking sector. Welcome to the Solomon Fadun, Risk Management of Everything channel. On this channel, you will see videos on risk management and its application to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to be notified when we upload new videos. Thank you. This video discusses banks' capital adequacy and its roles as a risk management tool in the banking sector. This video will help you understand the meaning of capital adequacy. This video will help you understand the meaning of banks' capital adequacy, importance, implications and components of banks' capital adequacy, key concepts of banks' capital adequacy, historical context of banks' capital adequacy, bank regulatory framework, banks' capital adequacy ratios and their importance, implications and limitations of capital adequacy ratios, impacts of capital adequacy on banks, practical application and analysis of banks' capital adequacy, impacts of regulatory changes on banks' capital adequacy, identifying and measuring banks' risks, strategies to circumvent banking regulatory requirements, cost implications of circumventing banking regulatory requirements, regulatory arbitrage and banks' compliance costs, impacts of economic cycles and market conditions on banks' capital adequacy, challenges in maintaining capital adequacy, challenges and criticisms of capital adequacy regulations, criticisms of capital adequacy regulations, future developments and trends in banks' capital adequacy, roles of technological advancements on banks' capital adequacy, strategies for banks to improve capital adequacy, implications of capital adequacy for banks, implications of capital adequacy for banking regulators, implications of capital adequacy for banks' customers, implications of banks' capital adequacy for the broader financial system, and roles of capital adequacy as a risk management tool in the banking sector. Now, let us start. The stability and robustness of the banking sector are crucial for the overall health of the global economy. Central to this stability is capital adequacy, which refers to the sufficiency of a bank's capital to its risk-weighted assets. Capital adequacy is a critical indicator of a bank's ability to absorb potential losses, safeguard depositors, and maintain confidence in the financial system. Over the past few decades, significant regulatory measures have been implemented to ensure banks maintain adequate capital levels. These measures, primarily encapsulated in the Basel Accords, Basel I, II and III, have evolved to address emerging risks and complexities within the banking industry. The Basel Accords set international standards for bank capital requirements to enhance financial stability and reduce the likelihood of banking crises. Despite these regulatory frameworks, maintaining optimal capital adequacy presents numerous challenges for banks. Economic fluctuations, regulatory compliance costs, and the rapid pace of technological advancements all influence a bank's capital strategy. Furthermore, balancing sufficient capital buffers and pursuing growth opportunities remains a delicate issue for bank management and policymakers. Banks' capital adequacy. Capital adequacy refers to a bank's ability to absorb losses and meet its obligations without becoming insolvent. It entails the minimum amount of capital a bank or financial institution must maintain to absorb losses and continue functioning during financial distress. Capital adequacy is a critical measure of a bank's financial health and stability, reflecting its capacity to withstand economic shocks and uncertainties. Adequate capital ensures that a bank can continue operations even in adverse conditions, thereby protecting depositors and maintaining confidence in the financial system. The primary function of capital is to support the bank's operations, act as a cushion to absorb unanticipated losses and declines in asset values that could otherwise cause a bank to fail, and provide protection to uninsured depositors and debt holders in the event of liquidation. Capital regulation is essential because deposit insurance and other elements of the federal safety net incentivize banks to increase their leverage beyond what the market would permit in the absence of depositor protection. The types and quantity of risk inherent in an institution's activities will determine the extent to which it may be necessary to maintain capital at levels above required regulatory minimums to properly reflect the potentially adverse consequences that these risks may have on the institution's capital. Importance of banks' capital adequacy. 1. Financial stability. Adequate capital is a buffer against losses, promoting stability within the banking sector and the broader financial system. 2. Confidence and trust. A well-capitalized bank is perceived as more reliable, enhancing depositor and investor confidence. 3. Regulatory compliance. Regulatory frameworks such as the Basel Accords mandate compliance with capital adequacy requirements. Non-compliance can result in penalties and increased scrutiny from regulators. 4. Risk management. Adequate capital ensures a bank can absorb losses without jeopardizing its solvency, enabling better risk management and planning. 5. Economic growth. Banks with sufficient capital are better positioned to extend credit, supporting economic activities and growth. Implications of banks' capital adequacy. 1. Enhanced resilience. Banks with solid capital adequacy are more resilient to financial crises and economic downturns, reducing the likelihood of bank failures and systemic risk. 2. Cost of capital. Maintaining higher capital levels can increase a bank's cost of capital, potentially impacting profitability. Banks must balance the need for sufficient capital with the desire to maximize shareholder returns. 3. Lending capacity. Adequate capital supports a bank's lending activities, enabling it to meet the credit needs of individuals and businesses. Conversely, more capital can be needed to constrain lending and impact economic growth. 4. Regulatory changes. Ongoing changes in regulatory requirements can affect a bank's capital adequacy. Banks must stay abreast of regulatory developments and adapt their capital strategies accordingly. 5. Market perception. Investors and rating agencies closely monitor banks' capital adequacy ratios. Strong capital positions can lead to better credit ratings and lower borrowing costs, while weak positions can result in downgrades and higher costs. Components of banks' capital adequacy. 1. Tier 1 capital. A bank's core capital consists primarily of common equity and disclosed reserves. It is the highest quality capital due to its permanent nature and role in absorbing losses. Common equity Tier 1, Set 1, includes common shares, retained earnings, and other comprehensive income. Additional Tier 1, AT1, capital, comprises subordinated instruments, has no maturity date, and is callable only at the issuer's discretion. 2. Tier 2 capital. This includes subordinated debt, hybrid instruments, and other instruments less readily available to absorb losses than Tier 1 capital. It also covers revaluation reserves, undisclosed reserves, and specific hybrid instruments. 3. Risk-weighted assets, RWA. Banks' assets are weighted according to their risk. Different assets carry different risk weights, with higher risk assets requiring more capital to safeguard against potential losses. Key concepts of banks' capital adequacy. Key concepts provide a comprehensive framework for understanding and assessing banks' capital adequacy, ensuring the banking sector's stability and resilience. 1. Capital Adequacy Ratio. Capital Adequacy Ratio, CAR, is a bank's capital ratio to its risk-weighted assets, RWA. It measures the bank's ability to absorb losses and meet its obligations. The Capital Adequacy Ratio, CAR, formula is Tier 1 capital plus Tier 2 capital divided by risk-weighted assets. However, some countries, including India, bank regulators integrated Tier 3 based on Basel III into their CAR. Hence, the Capital Adequacy Ratio, CAR, formula is stated as Tier 1 capital plus Tier 2 capital, plus Tier 3 capital funds divided by risk-weighted assets. These risk-weighted assets are considered credit, market, and operational risks. The Basel III norms stipulated a capital to risk-weighted assets of 8%. However, as per RBI norms, Indian scheduled commercial banks must maintain a CAR of 9%, while Indian public sector banks are required to maintain a CAR of 12%. Consequently, CAR ensures banks have enough capital to cover potential losses, promoting stability and confidence in the financial system. 2. Risk-weighted assets. Risk-weighted assets, RWA, refer to assets weighted according to their risk levels. Different assets have different risk weights based on their risk profiles. It provides a more accurate measure of a bank's capital adequacy by considering the riskiness of its assets. 3. Tier 1 capital. Tier 1 capital represents the highest quality capital that can absorb losses immediately when they occur. It comprises Common Equity Tier 1 and Additional Tier 1, AT1, capital. Common Equity Tier 1, Set 1, includes common shares, retained earnings, and other comprehensive income. Additional Tier 1, AT1, capital, includes subordinated instruments, have no maturity date, and are callable only at the issuer's discretion. 4. Tier 2 capital. Tier 2 capital includes subordinated debt, hybrid instruments, and other instruments less readily available to absorb losses than Tier 1 capital. It acts as a supplementary capital buffer that can absorb losses in liquidation. 5. Basel Accords. Basel I, II, and III are international regulatory frameworks developed by the Basel Committee on Banking Supervision, BCBS, to standardize banking regulations globally. Basel I introduced the concept of RWA and the minimum CAR. Basel II enhanced risk management and introduced the three-pillar approach: minimum capital requirements, supervisory review, and market discipline. Basel III strengthened capital requirements and introduced additional measures like the leverage ratio and liquidity requirements. The implication is that the Basel Accords provide a comprehensive framework for assessing and managing banks' capital adequacy. 6. Leverage ratio. This is a bank's Tier 1 capital ratio to its total exposure, including off-balance sheet exposures. The formula for the leverage ratio is Tier 1 capital divided by total exposure. The leverage ratio limits the extent to which a bank can leverage its capital, thereby reducing the risk of insolvency. 7. Stress testing. Stress testing is a risk management tool to evaluate how a bank's capital adequacy would be affected under adverse economic conditions. It helps banks and regulators understand the potential impact of severe but plausible scenarios on the bank's financial health. 8. Capital buffers. Capital conservation buffer. Banks must hold additional capital above the minimum CAR to absorb losses during financial and economic stress periods. Countercyclical capital buffer, a variable capital requirement that aims to protect the banking sector from periods of excess credit growth. Capital buffers enhance the resilience of banks during periods of financial instability. 9. Internal Capital Adequacy Assessment Process, ECAP. ECAP is a process banks use to assess their capital adequacy with their risk profiles and ensure they have sufficient capital to support their operations. ECAP ensures that banks proactively manage their capital levels and address potential risks. 10. Liquidity Coverage Ratio, LCR, and Net Stable Funding Ratio, NSFR. LCR requires banks to hold enough high-quality liquid assets, HQLA, to cover net cash outflows for 30 days under a stress scenario. NSFR ensures that banks maintain a stable funding profile relative to the composition of their assets and off-balance sheet activities. LCR and NSFR complement capital adequacy requirements by ensuring banks have sufficient liquidity to meet short-term and long-term obligations. Historical context of banks' capital adequacy. The concept of capital adequacy has evolved significantly over the past century, driven by financial crises, regulatory advancements, and the globalization of banking activities. Let us consider the historical context of banks' capital adequacy. Early banking regulation, pre-20th century. 1. Informal practices. Early banking systems relied on informal practices and individual bank policies to maintain solvency. Bankers often used personal reputations and family fortunes to assure depositors. 2. First attempts at regulation. Initial regulations were primarily national, focusing on reserve requirements and liquidity rather than explicit capital adequacy. 20th century developments. 1. Great Depression and its aftermath. The global financial crisis of the 1930s highlighted the need for more structured banking regulations. Governments introduced deposit insurance schemes and established central banks to provide liquidity and oversee the banking sector. 2. 1944 Bretton Woods Conference. The conference established the International Monetary Fund, IMF, and the World Bank, promoting international financial stability and cooperation. However, more specific capital adequacy standards were still needed. Post-World War II era. 1. Growth of international banking. The expansion of international banking activities in the 1960s and 1970s led to increased concerns over the stability of multinational banks. 2. 1974 Herstatt Bank crisis. The collapse of Germany's Herstatt Bank due to foreign exchange losses underscored the need for better regulation and coordination among countries. The Basel Accords. Basel I, 1988. 1. Basel I was formulated by the Basel Committee on Banking Supervision, BCBS, to create a standardized approach to bank capital regulation. Basel I introduced the concept of risk-weighted assets, RWA, and established a minimum capital requirement of 8% CAR. Impact marked the first major international effort to set uniform regulatory standards, improving the resilience of banks globally. Basel II, 2004, three-pillar approach. 1. Minimum capital requirements, expanded risk sensitivity by including operational risk and refining credit risk measurements. 2. Supervisory review process, encouraged regulators to assess banks' internal capital adequacy processes, ECAP. 3. Market discipline, enhanced disclosure requirements to promote transparency. Basel II, 2004, implementation challenges, faced criticism for its complexity and the variability in implementation across countries. Basel III, 2010. 1. Response to the global financial crisis, 2007 to 2009, aimed to address the shortcomings exposed by the crisis, which saw numerous banks fail or require government bailouts. 2. Enhanced capital requirements, increased the quality and quantity of capital, with a focus on common equity. 3. Introduction of capital buffers. Capital conservation buffer, additional 2.5% of RWA, besides the minimum requirement. Countercyclical buffer, variable buffer to protect against periods of excess credit growth. 4. Leverage ratio and liquidity standards. The leverage ratio and liquidity requirements, such as the LCR and NSFR, were introduced to ensure banks could withstand short-term and long-term liquidity stress. Recent developments. 1. Ongoing revisions. The BCBS continues to refine the Basel III framework to address emerging risks and ensure global consistency. 2. Technological and market changes. The rise of fintech, digital banking, and new financial instruments necessitates continuous updates to capital adequacy regulations. 3. COVID-19 pandemic highlighted the importance of robust capital buffers and liquidity management in maintaining financial stability during global economic shocks. The concept of capital adequacy has evolved significantly over the past century, driven by financial crises, regulatory advancements, and the globalization of banking activities. The establishment of the Basel Accords represents a significant milestone in creating a harmonized and effective regulatory framework that promotes the stability and resilience of the global banking system. As the financial landscape continues to change, ongoing adaptations to capital adequacy regulations are essential to address new challenges and ensure the continued health of the banking sector. Bank Regulatory Framework. The bank regulatory framework includes rules, guidelines, and practices to ensure the banking system's safety, soundness, and stability. Various national and international regulatory bodies implement this framework. Key components and principles of the bank regulatory framework include capital adequacy, liquidity requirements, risk management, supervisory oversight, and market discipline. Here are overviews of these elements. 1. Capital adequacy. Basel Accords. The Basel Committee on Banking Supervision, BCBS, has developed three significant frameworks, Basel I, II, and III, to ensure that banks maintain sufficient capital to absorb losses and protect depositors. Basel I, introduced in 1988, it established a minimum capital requirement of 8% of risk-weighted assets. Basel II, implemented in 2004, it introduced a more risk-sensitive framework with three pillars. Minimum capital requirements, enhanced risk weighting for credit, operational, and market risks. Supervisory review, encouraged national regulators to review banks' internal processes for assessing capital adequacy. Market discipline, enhanced disclosure requirements to improve transparency. Basel III, introduced in response to the 2007 to 2009 financial crisis, it further strengthened capital requirements and introduced new regulatory measures. Higher capital requirements, increased quality and quantity of capital, particularly Common Equity Tier 1, Set 1. Capital buffers, capital conservation buffer and countercyclical buffer to absorb losses during periods of financial and economic stress. Leverage ratio, a non-risk-based measure to limit excessive leverage. Liquidity requirements, liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, to ensure adequate liquidity over short and long-term horizons. 2. Liquidity requirements. Liquidity coverage ratio, LCR. This ratio ensures banks hold sufficient high-quality liquid assets to cover net cash outflows over a 30-day stress period. Net stable funding ratio, NSFR. This ratio promotes longer-term resilience by requiring banks to maintain a stable funding profile relative to their assets and off-balance sheet activities. 3. Risk management. Internal Capital Adequacy Assessment Process, ICAP. Banks must assess their capital adequacy with their risk profiles and ensure they have sufficient capital to support their operations. Stress testing. Banks are required to conduct regular stress tests to evaluate their ability to withstand adverse economic conditions and maintain adequate capital levels. Risk governance. Strong risk governance frameworks are necessary to ensure effective risk management practices, including establishing risk committees and appointing a chief risk officer, CRO. 4. Supervisory oversight. National regulatory authorities. Various national regulatory bodies oversee the implementation and compliance with banking regulations, such as the Federal Reserve in the United States, the Prudential Regulation Authority, PRA, in the United Kingdom, and the European Central Bank, ECB, in the Eurozone. Supervisory Review and Evaluation Process, SREP. Regulators evaluate banks' risk management frameworks, capital adequacy, and governance structures to ensure they comply with regulatory standards. 5. Market discipline. Disclosure requirements. Enhanced transparency through public disclosures allows market participants to assess banks' risk profiles, capital adequacy, and overall financial health. Corporate governance. Effective corporate governance practices, including independent board oversight, ensure that banks operate safely and soundly. 6. International coordination. Basel Committee on Banking Supervision, BCBS, provides a forum for international cooperation on banking supervisory matters and develops global standards. Financial Stability Board, FSB, coordinates at the international level the work of national financial authorities and international standard-setting bodies to develop and promote the implementation of effective regulatory, supervisory, and other financial sector policies. International Monetary Fund, IMF, and World Bank provide technical assistance and advice to countries on financial sector regulation and supervision. The bank regulatory framework is a comprehensive and dynamic system designed to ensure the banking sector's safety, soundness, and stability. It encompasses various elements, including capital adequacy, liquidity requirements, risk management, supervisory oversight, and market discipline. This framework's continuous evolution, driven by lessons from past financial crises and emerging risks, aims to protect depositors, maintain confidence in the financial system, and promote sustainable economic growth. The Basel Accords is a crucial bank regulatory framework. Hence, it is necessary to provide an overview of the differences between Basel I, II and III. Overview and differences of Basel I, II, and III. The Basel Accords are a series of international banking regulations developed by the Basel Committee on Banking Supervision, BCBS, to ensure that financial institutions maintain adequate capital to absorb potential losses and promote stability in the global financial system. Here, we discuss and differentiate between Basel I, II and III, highlighting their key features, objectives, and differences. Basel I, 1988. Objectives and key features of Basel I. 1. Introduction. Basel I was introduced in 1988 and focused on credit risk. 2. Capital requirements. Established minimum capital requirements for banks, primarily focusing on credit risk. 3. Risk weighting. Introduced a system of risk weighting assets to determine banks' capital adequacy. 4. Minimum capital ratio. Set a minimum capital adequacy ratio of 8%, calculated as the ratio of a bank's capital to its risk-weighted assets, RWAs. Components of Basel I. Tier 1 capital, core capital, including common equity and disclosed reserves. Tier 2 capital, supplementary capital, including subordinated debt and other less stable sources of capital. Limitations of Basel I. 1. Simplistic risk weighting. The risk weighting system needed to be more complex, adequately capturing the complexities of different types of risks. 2. Focus on credit risk, primarily focused on credit risk, ignoring other market and operational risks. Basel II, 2004. Objectives and key features of Basel II. Enhanced risk sensitivity, aim to address the limitations of Basel I by introducing more risk-sensitive measures. 3 pillars approach, structured around 3 pillars to provide a comprehensive framework for risk management. 3 pillars of Basel II. Pillar 1, minimum capital requirements. Pillar 1 expanded the risk categories to include credit, market, and operational risks. It introduced the internal ratings-based (IRB) approach, allowing banks to use their internal models to assess credit risk. Pillar 2, supervisory review process. Pillar 2 of the Basel II emphasized the importance of supervisory oversight and review processes and encouraged banks to develop and implement robust risk management practices and internal controls. Pillar 3, market discipline. Pillar 3 of the Basel II focused on enhancing transparency and market discipline through improved disclosure requirements. Hence, banks must disclose detailed information about risk profiles, capital adequacy, and risk management practices. Basel II improvements and challenges. 1. Improved risk sensitivity. Basel II's risk-sensitive approach provided a more accurate assessment of banks' risk profiles. 2. Complexity. Implementing Basel II was complex and resource-intensive, requiring significant risk management systems and process investments. 3. Procyclicality: the framework was criticized for its procyclical nature, which could potentially exacerbate economic downturns by requiring banks to hold more capital during recessions. Basel III, 2010. Objectives and key features of Basel III. 1. Post-crisis reforms. In response to the 2007 to 2009 global financial crisis, Basel III aimed to strengthen bank regulation, supervision, and risk management. 2. Enhanced capital requirements, introduced more stringent capital requirements to improve the quality and quantity of capital held by banks. Key enhancements of Basel III. 1. Capital requirements. Common Equity Tier 1, CET1, ratio, increased the minimum CET1 ratio to 4.5% of RWAs. Tier 1 capital ratio, raised the minimum Tier 1 capital ratio to 6% of RWAs. Total capital ratio, maintained the total capital ratio at 8% of RWAs but with stricter definitions of capital components. 2. Capital buffers. Capital conservation buffer, introduced a 2.5% buffer above the minimum capital requirements to absorb losses during financial and economic stress periods. Countercyclical buffer, allowed national regulators to require an additional buffer of up to 2.5% during periods of excessive credit growth to mitigate systemic risk. 3. Leverage ratio. Introduced a leverage ratio to complement the risk-based capital requirements, ensuring that banks maintain an adequate level of equity capital relative to their total exposure. 4. Liquidity standards. Liquidity coverage ratio, LCR, required banks to hold sufficient high-quality liquid assets, HQLA, to cover net cash outflows over a 30-day stress period. Net stable funding ratio, NSFR, ensured that banks maintain a stable funding profile relative to their assets and off-balance sheet activities over 1 year. 5. Systemically important banks, SIBs. Basel III introduced additional capital surcharges for globally systemically important banks, G-SIBs, to reduce the risk of failure and the potential impact on the global financial system. Improvements and challenges of Basel III. 1. Increased resilience. Basel III significantly improved the banking sector's resilience by enhancing capital and liquidity standards. 2. Implementation costs. The stricter requirements challenged banks regarding compliance costs and operational adjustments. 3. Ongoing revisions. Basel III has undergone several revisions and updates to address emerging risks and ensure its effectiveness in maintaining financial stability. Summary of differences between Basel I, II and III. Let us consider the summary of differences between Basel I, II and III, shown in this table. 1. Focus. The Basel I focuses on credit risk, Basel II on comprehensive risk management, and Basel III on post-crisis reforms. 2. Capital requirements. Basel I's capital requirements are an 8% minimum ratio. Basel II's capital requirements are risk-sensitive and expanded risk categories, and Basel III's capital requirements are higher quality and quantity of capital. 3. Risk sensitivity. The Basel I risk sensitivity is simplistic, Basel II risk sensitivity is enhanced with the IRB approach, and Basel III risk sensitivity is further enhanced with stricter definitions. 4. Regulatory approach. The Basel I regulatory approach has uniform standards, the Basel II regulatory approach has 3 pillars: minimum capital, supervision, disclosure, and the Basel III regulatory approach is comprehensive: capital, liquidity, and leverage. 5. Capital buffers. Basel I and II do not include capital buffers, but Basel III has capital conservation and countercyclical buffers. 6. Leverage ratio. Basel I and II do not include leverage ratios, but Basel III introduced leverage ratios to banks' capital adequacy requirements. 7. Liquidity standards. Basel I and II do not include liquidity standards, but Basel III introduced liquidity standards, including liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, to banks' capital adequacy requirements. 8. Systemically important banks. Basel I and II do not indicate systemically important banks, but Basel III makes provision for systemically important banks, including additional surcharges for global systemically important banks, GSIBs. The evolution from Basel I to Basel III reflects the increasing complexity and sophistication of the global banking system and the need for more comprehensive and resilient regulatory frameworks. Basel I provided the foundation with basic capital requirements. Basel II introduced a more risk-sensitive approach and enhanced supervisory review. Basel III addressed the shortcomings arising from exposure to the global financial crisis by significantly strengthening capital and liquidity standards. Understanding these differences is crucial for regulators, banks, and stakeholders to navigate the regulatory landscape and ensure financial stability. Banks' Capital Adequacy Ratios. Capital Adequacy Ratio, CAR, is a bank's capital ratio based on risk-weighted assets and current liabilities. Central banks and bank regulators decide this ratio to prevent commercial banks from taking excessive leverage and becoming insolvent. Bank Capital Adequacy Ratios, CAR, are financial metrics used to measure a bank's capital relative to its risk-weighted assets. These ratios are crucial indicators of a bank's ability to absorb potential losses and protect depositors. The main capital adequacy ratios are the Common Equity Tier 1, CET1, ratio, the Tier 1 capital ratio, and the Total Capital ratio. Using relevant data, let us compute banks' capital adequacy ratios, CAR. We need the following relevant data to compute banks' capital adequacy ratios, CAR. 1. Common Equity Tier 1, CET1, capital. 2. Tier 1 capital, including CET1 and additional Tier 1, AT1, capital. 3. Total capital, including Tier 1 and Tier 2 capital. 4. Risk-weighted assets, RWA. Assuming we have the following data for a hypothetical bank. Common Equity Tier 1, CET1, capital, $50 million. Additional Tier 1, AT1, capital, $10 million. Tier 2 capital, $20 million. Risk-weighted assets, RWA, $500 million. We can now compute the capital adequacy ratios. 1. Common Equity Tier 1, CET1, ratio. The CET1 ratio formula is Common Equity Tier 1 capital divided by risk-weighted assets. This equals $50 million divided by $500 million. The result is 0.10, which means 10%. 2. Tier 1 capital ratio. The Tier 1 capital ratio formula is Tier 1 capital divided by risk-weighted assets. This equals $50 million plus $10 million divided by $500 million, which is $60 million divided by $500 million. The result is 0.12, which means 12%. 3. Total capital ratio. The total capital ratio formula is total capital, Tier 1 plus Tier 2, divided by risk-weighted assets. This equals $60 million plus $20 million divided by $500 million, which is $80 million divided by $500 million. The result is 0.16, which means 16%. Summary of capital adequacy ratios calculation. Common Equity Tier 1, CET1, ratio, 10%. Tier 1 capital ratio, 12%. Total capital ratio, 16%. These ratios indicate that the hypothetical bank maintains capital well above the minimum requirements set by Basel III, which are 4.5% for CET1, 6% for Tier 1 capital, and 8% for total capital. This suggests a strong capital position, enhancing the bank's ability to absorb potential losses and maintain financial stability. Importance of Banks Capital Adequacy Ratios. Banks Capital Adequacy Ratios, CAR, are vital financial health and stability indicators. They are crucial in ensuring banks can absorb potential losses and continue operating without posing risks to depositors or the broader financial system. Here are the key reasons why CAR is essential. 1. Financial stability. Loss absorption. CAR ensures that banks have enough capital to absorb unexpected losses, reducing the risk of insolvency. Crisis prevention. Strong CAR helps prevent bank failures, which can have systemic impacts and lead to financial crises. 2. Protection of depositors. Confidence building. Adequate capital ratios reassure depositors that their funds are safe, reducing the likelihood of bank runs. Safety net. Adequate capital acts as a buffer protecting depositors' funds in a bank's financial distress. 3. Regulatory compliance. Basel Accords. Compliance with international regulatory standards, such as the Basel III requirements, is essential for banks to operate legally and avoid penalties. National regulations. Adherence to national regulations helps maintain the integrity and stability of the domestic banking sector. 4. Risk management. Risk assessment. A bank's CAR reflects its risk-weighted assets, ensuring that riskier assets are backed by more capital. Risk mitigation. Banks can better manage and mitigate risks associated with their lending and investment activities by maintaining adequate capital. 5. Market confidence. Investor assurance. Strong capital ratios enhance investor confidence in the bank's financial health and stability. Credit ratings. Credit rating agencies consider CAR when assessing a bank's creditworthiness, influencing its borrowing costs and market reputation. 6. Economic stability. Credit availability. Well-capitalized banks are more likely to continue lending during economic downturns, supporting economic growth and stability. Sustainable growth. Adequate capital levels enable banks to pursue growth opportunities without compromising their financial stability. 7. Corporate governance and transparency. Enhanced oversight. CAR requires banks to implement robust internal controls and risk management frameworks, promoting better corporate governance. Transparency. Disclosure of CAR promotes transparency, allowing stakeholders to make informed decisions based on the bank's financial health. 8. Strategic planning and decision-making. Informed decisions. Adequate capital ratios allow bank management to make informed strategic decisions, balancing growth objectives with risk management. Capital allocation. CAR helps banks allocate capital efficiently, maintaining sufficient buffers while optimizing returns. Banks' capital adequacy ratios are fundamental to maintaining the stability and integrity of the financial system. They ensure banks can absorb losses, protect depositors, comply with regulatory requirements, manage risks, and sustain market confidence. By upholding strong CAR, banks contribute to economic stability and growth, making these ratios a cornerstone of prudent banking practices and effective regulatory oversight. It is necessary to discuss, compare, and contrast banks' capital adequacy ratios, CAR, and solvency ratios. Implications of capital adequacy ratios. Capital adequacy ratios are essential for assessing a bank's financial strength and stability. These ratios help protect depositors, promote confidence in the financial system, and support sustainable economic growth by ensuring that banks maintain sufficient capital relative to their risk-weighted assets. Here are the implications of capital adequacy ratios. 1. Financial stability. Higher capital adequacy ratios indicate more robust financial health, enabling banks to absorb losses without threatening their solvency. 2. Regulatory compliance. Banks must maintain these ratios to comply with regulatory requirements and avoid penalties. 3. Investor confidence. Strong capital ratios enhance investor confidence, reflecting the bank's ability to manage risks and sustain operations during economic downturns. 4. Credit ratings. Credit rating agencies consider capital adequacy ratios when assessing a bank's creditworthiness, influencing its borrowing costs and access to capital markets. Limitations of banks' capital adequacy ratios. While banks' capital adequacy ratios, CAR, are critical for assessing financial stability and regulatory compliance, they also come with several limitations that can affect their operations and effectiveness. 1. Risk-weighting variability. Risk-weighted assets, RWA, calculations can vary significantly across banks and jurisdictions, leading to consistency in CAR comparisons. Banks may use internal models for risk weighting, which could lead to potential discrepancies in risk assessment and capital allocation. 2. Procyclicality. CAR calculations can exacerbate economic cycles. During economic expansions, risk-weighted assets may decrease, artificially inflating CAR. Conversely, risk-weighted assets may increase during downturns, potentially triggering capital shortages. This procyclicality can lead to protracted credit crunches or excessive lending during economic booms, destabilizing the financial system. 3. Complexity and calculation methods. CAR involves complex calculations and methodologies, including the determination of risk weights and the inclusion/exclusion of certain assets. The complexity can hinder transparency and make it easier for stakeholders to thoroughly understand and accurately compare banks' capital positions. 4. Focus on quantity over quality. CAR primarily focuses on the quantity of capital rather than the quality. Common Equity Tier 1, Set 1, is the highest quality capital, but CAR does not explicitly differentiate between different types of capital in its minimum requirements. Banks may meet minimum CAR requirements with lower quality capital instruments, potentially reducing their ability to absorb losses effectively. 5. Lack of coverage for all risks. CAR primarily addresses credit, market, and operational risks but may not fully capture other emerging risks, for example, cyber risks, climate risks, that could impact a bank's financial health. Banks may face unexpected losses from non-traditional risks not adequately covered by CAR, undermining overall financial stability. 6. Regulatory arbitrage. Banks may use regulatory arbitrage to manipulate CAR calculations by adjusting asset allocation or using complex financial instruments. This behavior can distort banks' risk profiles and undermine the effectiveness of CAR as a regulatory tool. 7. Static nature. CAR is calculated at a time and may not dynamically reflect changes in a bank's risk profile or financial condition. Banks could experience sudden changes in risk exposures or financial situations that CAR fails to capture promptly, potentially delaying regulatory interventions. 8. International variability in standards. CAR standards and implementation can vary across countries, leading to regulatory fragmentation and challenges in achieving global financial stability. Inconsistencies in CAR requirements may complicate cross-border banking operations and regulatory compliance. Despite its significance in ensuring financial stability and regulatory compliance, banks' capital adequacy ratios, CAR, are not without limitations. Addressing these limitations through enhanced transparency, standardized methodologies, and consideration of broad risk factors can strengthen the effectiveness of CAR in safeguarding the financial system and promoting sustainable economic growth. Next, let us discuss, compare, and contrast banks' capital adequacy ratios, CAR, and solvency ratios. Banks' capital adequacy ratios versus solvency ratio. Capital adequacy ratios. Capital adequacy ratios, CAR, are a set of standardized metrics used to measure a bank's capital to its risk-weighted assets, RWA. These ratios are critical for determining a bank's ability to absorb losses and remain solvent under adverse conditions. Key ratios. 1. Common Equity Tier 1, Set 1, ratio. The Common Equity Tier 1, Set 1, ratio formula is Set 1 capital divided by risk-weighted assets. CET1 ratio is essential because it represents the highest quality of regulatory capital, consisting of common equity. 2. Tier 1 capital ratio. The Tier 1 capital ratio formula is Tier 1 capital divided by risk-weighted assets. The Tier 1 capital ratio is vital because it includes CET1 and additional Tier 1, AT1, capital, indicating the bank's core financial strength. 3. Total capital ratio. The total capital ratio formula is total capital, Tier 1 plus Tier 2, divided by risk-weighted assets. Total capital ratio is crucial because it provides a comprehensive view of the bank's capital, including Tier 1 capital and Tier 2 capital. Generally, capital adequacy ratios are essential for the following reasons. 1. Regulatory compliance. This ensures that banks meet the minimum capital requirements of regulatory bodies like the Basel Committee on Banking Supervision, BCBS. 2. Financial stability, helps maintain stability by ensuring banks have enough capital to cover potential losses. 3. Investor confidence, strong CAR enhances market confidence in the bank's financial health. Solvency ratio. The solvency ratio measures how much a company or financial institution can meet its long-term debt obligations. It is a broader measure than CAR and is used to assess overall financial health and long-term viability. The solvency ratio formula is net income plus depreciation divided by total liabilities. Components of solvency ratio. Net income, the bank's profit after all expenses and taxes. Depreciation, non-cash expense representing the allocation of the cost of tangible assets over their useful lives. Total liabilities, the sum of all financial obligations, including short-term and long-term debt. Importance of solvency ratio. Long-term viability, indicates the bank's ability to meet long-term debt obligations and sustain operations over the long term. Comprehensive financial health, provides a broader picture of financial health compared to CAR, as it considers all liabilities and not just risk-weighted assets. Stakeholder assurance, assures stakeholders of the bank's ability to manage its liabilities and remain solvent in the long run. We have computed CAR in this video earlier, so let us compute solvency ratios. We need relevant data, such as the bank's net income and total liabilities, to calculate a bank's solvency ratio. For illustration purposes, let's assume we have the following data for a fictional bank, Bank XYZ, for a given fiscal year. Net income, $500 million. Total liabilities, $20 billion. The solvency ratio formula is net income plus depreciation divided by total liabilities. Let us use the following data for calculation. Net income, $500 million. Total liabilities, $20 billion. The solvency ratio formula is net income divided by total liabilities, which means $500 million divided by $20 billion. This equals 1 divided by 40, and the result is 0.025. If converted to a percentage, this gives us 2.5%. Interpretation. A solvency ratio of 2.5% indicates that Bank XYZ generates enough net income to cover 2.5% of its total liabilities. This ratio provides insight into the bank's ability to meet its long-term obligations. A higher solvency ratio generally indicates better financial health and a greater ability to withstand financial stress. Practical example with real data. To calculate solvency ratios for real banks, we need to access their financial statements, typically available in annual reports or regulatory filings. Let us hypothetically use data from two well-known banks for a more concrete example. Here is the data for Bank A. Net income, $10 billion. Total liabilities, $1 trillion. The solvency ratio formula is net income divided by total liabilities, which means $10 billion divided by $1 trillion. This equals 10 divided by 1000, and the result is 0.01. If converted to a percentage, this gives us 1%. Here is the data for Bank B. Net income, $15 billion. Total liabilities, $800 billion. The solvency ratio formula is net income divided by total liabilities, which means $15 billion divided by $800 billion. This equals 15 divided by 800, and the result is 0.01875. If converted to a percentage, this gives us 1.875%. Interpretation of results. Bank A, a solvency ratio of 1% indicates that bank A generates net income sufficient to cover 1% of its total liabilities. This is relatively low, suggesting that bank A might have a higher risk of financial distress in the long term. Bank B, a solvency ratio of 1.875% is higher than Bank A's, indicating better financial health and a stronger ability to meet long-term obligations. The solvency ratio provides valuable insights into a bank's financial health and long-term viability. Stakeholders can assess relative financial stability and risk levels by comparing solvency ratios across banks. However, solvency ratios should be considered with other financial metrics and qualitative factors for a comprehensive analysis. CAR and the solvency ratio are crucial for assessing a bank's financial health, but they serve different purposes. CAR focuses on absorbing losses in the short to medium term, ensuring regulatory compliance and stability. In contrast, the solvency ratio provides a broader measure of long-term financial health and the ability to meet all financial obligations. They offer a comprehensive view of a bank's financial resilience and stability. Let us discuss the similarities and differences between banks' capital adequacy ratios, CAR, and solvency ratios. Similarities and differences between banks' capital adequacy ratios, CAR, and solvency ratios. Capital adequacy ratios, CAR, and solvency ratios are crucial for assessing banks' financial health and stability. While they share some similarities, they fundamentally differ in their definitions, calculations, and implications. Similarities. Differences between banks' capital adequacy ratios, CAR, and solvency ratios. 1. Financial stability indicators. Current solvency ratios indicate a bank's financial health and ability to withstand financial stress. They provide insights into a bank's capacity to absorb losses and continue operations during adverse economic conditions. 2. Regulatory importance. Both ratios are important for regulatory compliance and are used by regulatory authorities to assess the risk and stability of banks. They help regulators ensure banks maintain sufficient capital to cover their risks and protect the financial system. 3. Risk management. Both ratios are integral to the bank's risk management framework. They encourage banks to maintain adequate capital levels to mitigate various risks, including credit, market, and operational risks. Differences between banks' capital adequacy ratios, CAR, and solvency ratios. 1. Definition and focus. Capital adequacy ratio, CAR, focuses on the relationship between a bank's capital and risk-weighted assets, RWAs. Measures the bank's capital strength with its risk exposures. Solvency ratio measures a bank's ability to meet its long-term obligations and liabilities. It focuses on the bank's overall financial stability and long-term viability. 2. Components and calculation. CAR includes Tier 1 capital, that is, core capital, including common equity and retained earnings, and Tier 2 capital, that is, supplementary capital, including subordinated debt and hybrid instruments. Risk-weighted assets are calculated based on the riskiness of various asset classes, with higher risk assets requiring more capital. Solvency ratio is primarily based on the bank's income and total liabilities. It focuses on the bank's ability to generate sufficient revenue to cover its liabilities over the long term. 3. Purpose and implications. CAR ensures that banks have enough capital to cover potential losses from their risk exposures. It helps assess the bank's ability to absorb short-term shocks and maintain regulatory capital requirements. Moreover, CAR is directly linked to regulatory frameworks like Basel III. Solvency ratios evaluate a bank's overall financial health and long-term sustainability. They provide insights into the bank's ability to meet long-term obligations and continue operations. The solvency ratio is more relevant for understanding the bank's long-term viability and is less influenced by short-term fluctuations. 4. Regulatory and financial reporting. CAR is a vital regulatory requirement under frameworks such as Basel III. Banks must maintain minimum CAR levels to avoid regulatory penalties and ensure financial stability. CAR is regularly monitored and reported to regulatory authorities. Solvency ratios are not typically a specific regulatory requirement for banks but are essential for overall financial analysis and long-term planning. Investors, analysts, and credit rating agencies use them more to assess the bank's long-term health and stability. Both capital adequacy ratios, CAR, and solvency ratios are essential metrics for assessing banks' financial health and stability, but they serve different purposes and focus on different aspects of financial strength. CAR is primarily a regulatory measure focused on banks' ability to absorb short-term losses and manage risk. Similarly, the solvency ratio is a broader measure of the bank's long-term viability and ability to meet its obligations. They provide a comprehensive view of a bank's financial resilience and stability. Impacts of capital adequacy on banks. The impact of capital adequacy ratios, CAR, on banks is profound and multifaceted, influencing various aspects of their operations, financial health, and regulatory compliance. Here are the key impacts of CAR on banks. 1. Financial stability. Loss absorption. Adequate capital ensures banks can absorb losses without becoming insolvent, enhancing financial stability. Risk management. CAR incentivizes banks to maintain prudent risk management practices, aligning their capital levels with the riskiness of their assets. Market confidence. Strong CAR enhances investor and depositor confidence, reducing the likelihood of bank runs and financial panic. 2. Regulatory compliance. Basel Accords. CAR requirements are mandated by international standards, for example, Basel III, ensuring banks comply with minimum capital thresholds set by regulatory authorities. Capital buffers. CAR includes regulatory buffers, for example, capital conservation buffer, which provide additional resilience during periods of economic stress. 3. Cost of capital. Borrowing costs. Banks with stronger CAR may enjoy lower borrowing costs due to enhanced credit ratings and reduced perceived risk. Market access. Adequate CAR facilitates access to capital markets, allowing banks to raise funds more efficiently and at competitive rates. 4. Operational flexibility. Lending capacity. Banks with higher CAR have greater capacity to extend loans and support economic growth, especially during economic downturns when credit availability is crucial. Strategic investments. Adequate capital levels enable banks to pursue strategic investments and business expansion opportunities without compromising financial stability. 5. Risk appetite and profitability. Risk-taking behavior. CAR influences banks' risk appetite by setting thresholds for capital allocated to riskier assets. Profitability. Balancing CAR with profitability objectives ensures sustainable growth and prevents excessive risk-taking that could jeopardize long-term profitability. 6. Corporate governance and transparency. Internal controls. CAR requirements promote robust internal controls and governance practices, ensuring effective oversight of capital management. Disclosure standards. Enhanced transparency in CAR reporting fosters trust among stakeholders and regulatory authorities, promoting accountability and ethical conduct. 7. Systemic stability. Financial system resilience. Overall, adequate CAR across banks contributes to systemic stability, reducing the likelihood of financial contagion and systemic crises. Macroprudential policy. CAR is a key tool in macroprudential policy, helping regulators monitor and mitigate systemic risks within the financial system. Capital adequacy ratios, CAR, are pivotal in shaping bank behavior, resilience, and regulatory compliance. CAR safeguards financial stability, enhances market confidence, and supports sustainable economic growth by ensuring banks maintain sufficient capital relative to their risk exposures. Effective management of CAR is essential for navigating regulatory requirements, optimizing profitability, and mitigating risks in a dynamic and interconnected global financial environment. Factors influencing banks' capital adequacy. Many factors influence banks' capital adequacy, broadly categorized into regulatory, economic, operational, and strategic considerations. Understanding these factors is crucial for banks, regulators, and stakeholders to ensure that banks maintain sufficient capital to absorb losses and support financial stability. 1. Regulatory factors. A. Basel Accords. Basel III requirements, global standards set by the Basel Committee on Banking Supervision, BCBS, mandate minimum capital ratios, including CET1, Tier 1, and total capital ratios. Banks must comply with these ratios to avoid regulatory penalties. Capital buffers. The Basel III framework introduces capital conservation buffers and countercyclical buffers, which require banks to hold additional capital during economic booms to mitigate risks during downturns. B. National regulations. Local adaptations. National regulatory authorities may impose additional requirements based on the country's domestic economic conditions and financial stability. Stress testing and supervisory reviews. Regulators conduct regular stress tests and supervisory reviews to assess banks' resilience and capital adequacy under adverse scenarios. 2. Economic factors. A. Economic cycles. Booms and busts. Economic cycles impact the level of capital banks need to maintain. Banks might need to hold more capital during economic booms to prepare for potential downturns. Interest rates. Changes in interest rates can affect banks' profitability and risk profiles, influencing capital adequacy. For example, low interest rates can compress margins, while high rates can increase credit risk. B. Market conditions. Credit risk. Economic conditions influence borrowers' credit quality. Higher default rates during economic downturns can erode banks' capital. Market volatility. Fluctuations in asset prices, including securities and real estate, can impact the value of banks' assets and, thus, their capital ratios. 3. Operational factors. A. Risk management. Risk appetite and policies. Banks' internal risk management frameworks, including their risk appetite and policies, are crucial in determining capital adequacy. Credit, market, and operational risk. Effective management of these risks through diversification, hedging, and robust internal controls influences the amount of capital banks need to hold. B. Profitability. Earnings retention. Banks' ability to generate and retain earnings directly impacts their capital base. Profitable banks can build capital through retained earnings. Cost efficiency. Operational efficiency and cost management affect profitability and capital adequacy. 4. Strategic factors. A. Business model. Asset mix. The composition of assets, such as loans, investments, and off-balance sheet exposures, determines the risk profile and capital requirements. Geographic diversification. Banks operating in multiple regions may face diverse regulatory requirements and economic conditions, influencing their capital adequacy. B. Growth strategy. Expansion plans. Aggressive growth strategies, including mergers and acquisitions, can strain capital adequacy if not managed prudently. Dividend policies. Decisions on dividend payouts versus earnings retention impact the capital available to absorb losses. 5. External factors. A. Technological advancements. Fintech and digital transformation. Adopting new technologies can enhance risk management and operational efficiency, potentially positively influencing capital adequacy. Cybersecurity risks. Increasing reliance on technology also introduces new risks, requiring banks to hold additional capital to cover potential losses from cyber incidents. B. Political and legal environment. Regulatory changes. Changes in domestic and international regulatory policies can impact capital requirements and banks' strategies to meet them. Litigation and legal risks. Legal challenges and compliance with new laws can affect banks' capital through potential fines and operational disruptions. 6. Market perception and confidence. A. Investor confidence. Market perception. Investor confidence in a bank's financial health and stability can influence its stock price and access to capital markets. Rating agencies. Credit ratings from agencies like Moody's, S&P, and Fitch impact borrowing costs and market perception of banks' capital adequacy. B. Stakeholder expectations. Regulators, shareholders, and customers' expectations from various stakeholders regarding financial stability, transparency, and prudent management practices shape banks' capital strategies. Banks' capital adequacy is shaped by a complex interplay of regulatory, economic, operational, strategic, and external factors. Effective management of these factors is essential for maintaining financial stability, meeting regulatory requirements, and ensuring the confidence of investors, customers, and other stakeholders. Continuous assessment and adaptation to changing conditions are crucial for banks to sustain adequate capital levels and support their long-term viability. Comparative analysis of banks' capital adequacy requirements, regional and global perspectives. Capital adequacy requirements are fundamental to the stability and health of banks worldwide. While a global framework is set by the Basel Committee on Banking Supervision, BCBS, regional variations exist due to local economic conditions, regulatory environments, and specific financial stability concerns. Here is a comparative analysis of banks' capital adequacy requirements across different regions and globally. Global standards, Basel Accords. Basel III. Minimum capital requirements. 1. Common Equity Tier 1, Set 1, ratio, minimum of 4.5% of risk-weighted assets, RWAs. 2. Tier 1 capital ratio, minimum of 6% of RWAs. 3. Total capital ratio, minimum of 8% of RWAs. Capital conservation buffer, additional 2.5% of RWAs, bringing the total minimum requirement to 10.5%. Countercyclical buffer, up to 2.5% of RWAs, varying by jurisdiction based on macroeconomic conditions. Leverage ratio, minimum of 3%, measured as Tier 1 capital over total exposure. Regional implementation. United States. Basel III implementation. Set 1 ratio, 4.5%. Tier 1 capital ratio, 6%. Total capital ratio, 8%. Leverage ratio, 4% for most banks, 5% for globally systemically important banks, G-SIBs. Supplementary leverage ratio, SLR, 3% additional for G-SIBs. Stress testing and capital planning, comprehensive capital analysis and review, CCAR, and Dodd-Frank Act stress tests, DFAST. European Union. CRD4/CRR, Capital Requirements Directive 4 and Capital Requirements Regulation. Aligns with Basel III standards but with additional requirements and buffers. Set 1 ratio, 4.5%. Tier 1 capital ratio, 6%. Total capital ratio, 8%. Capital conservation buffer, 2.5%. Countercyclical buffer, up to 2.5%. Leverage ratio, 3% minimum. Pillar 2 requirements, additional capital requirements based on bank-specific risk assessments by national regulators. Additional buffers, G-SIB and other systemically important institutions, OCs, are subject to additional capital surcharges. United Kingdom. Basel III implementation. Similar to the EU standards but under the Bank of England and Prudential Regulation Authority, PRA, supervision. CET1 ratio, 4.5%. Tier 1 capital ratio, 6%. Total capital ratio, 8%. Leverage ratio, 3%. Ring-fencing requirements. Large UK banks must ring-fence their retail operations to protect depositors from risks arising from investment banking activities. Stress testing. Annual stress tests conducted by the Bank of England. Japan. Basel III implementation. CET1 ratio, 4.5%. Tier 1 capital ratio, 6%. Total capital ratio, 8%. Leverage ratio, 3%. Additional domestic regulations may include higher requirements for domestic systemically important banks, D-SIBs. Liquidity requirements. Higher liquidity coverage ratios, LCR, ensure banks hold enough high-quality liquid assets. China. Basel III implementation. CET1 ratio, 4.5%. Tier 1 capital ratio, 6%. Total capital ratio, 8%. Capital conservation buffer, 2.5%. Countercyclical buffer, up to 2.5%. Additional domestic requirements, stricter requirements for large state-owned banks and D-SIBs. Regulatory Authority, China Banking and Insurance Regulatory Commission, CBIRC. Similarities of Banks Capital Adequacy Requirements. 1. Adoption of Basel III standards. Most regions align with Basel III minimum requirements, emphasizing CET1, Tier 1, and total capital ratios. 2. Capital conservation and countercyclical buffers, common implementation of additional buffers to enhance financial stability. 3. Leverage ratio, a baseline leverage ratio requirement, typically 3%, is standard across regions. 4. Stress testing, regular stress testing to assess banks' resilience under adverse economic scenarios is widespread. Differences between banks' capital adequacy requirements. 1. Additional capital buffers. The US and EU impose additional capital surcharges on G-SIBs and OCs, reflecting their systemic importance. Due to domestic financial stability concerns, Japan and China may impose higher capital requirements for their largest banks. 2. Leverage ratio variations. The US imposes a higher supplementary leverage ratio for G-SIBs than other regions. The EU has additional Pillar 2 requirements tailored to individual banks' specific risk profiles. 3. Regulatory and supervisory frameworks. The US has the CCAR and DFAST frameworks, which include comprehensive capital planning and stress testing requirements. The UK has specific ring-fencing requirements to separate retail banking from investment banking activities. China's CBIRC imposes stricter liquidity requirements and supervises capital adequacy more closely for large state-owned banks. 4. Regional adaptations. The EU's CRD4/CRR framework includes additional regulatory requirements beyond Basel III. Japan has specific requirements for liquidity coverage ratios that are higher than Basel III standards. While there is a broad alignment with Basel III standards globally, regional variations reflect local economic conditions, regulatory environments, and specific financial stability concerns. These differences in capital adequacy requirements ensure that the banking sectors in different regions are resilient and capable of withstanding region-specific risks. Understanding these similarities and differences is crucial for stakeholders, including regulators, banks, and investors, to navigate the global financial landscape effectively. Practical application and analysis of banks' capital adequacy. Capital adequacy is critical to a bank's financial strength and stability. Its practical application and analysis involve assessing how well a bank is equipped to absorb losses, meet regulatory requirements, and sustain its operations under adverse conditions. Here are the practical applications and analyses of banks' capital adequacy. 1. Calculation of capital adequacy ratios, CAR. Components of CAR. Tier 1 capital, core capital, which includes common equity Tier 1, Set 1, such as common shares, retained earnings, and other comprehensive income. Tier 2 capital, supplementary capital, which includes subordinated debt, hybrid instruments, and other items that provide loss-absorbing capacity. The capital adequacy ratios formula is Tier 1 capital plus Tier 2 capital divided by risk-weighted assets, multiplied by 100%. 2. Risk-weighted assets, RWA. RWA are the bank's assets weighted according to credit risk. As defined by regulatory standards, different assets are assigned different risk weights based on their risk profile, as follows. Loans and advances, weighted based on borrower risk ratings. Marketable securities, weighted based on the type and credit quality of the securities. Operational risks, assessed using standardized or advanced measurement approaches. Market risks, calculated using the value at risk, VaR, model. 3. Practical application, with calculation. Suppose Bank A has the following components. Tier 1 capital, $100 million. Tier 2 capital, $20 million. Risk-weighted assets, $800 million. The capital adequacy ratios formula is Tier 1 capital plus Tier 2 capital divided by risk-weighted assets multiplied by 100%. This equals $100 million plus $20 million divided by $800 million multiplied by 100%, which is 15%. This indicates that Bank A has a CAR of 15%, above the minimum regulatory requirement, for example, Basel III's 10.5%, including capital conservation buffer. 4. Stress testing. Stress testing assesses a bank's capital adequacy under adverse economic scenarios to ensure it can withstand shocks. Stress testing process. Define scenarios, develop adverse economic scenarios, for example, recession or market crash. Run simulations, apply scenarios to the bank's financials to estimate potential losses. Evaluate impact, assess the impact on CAR and determine if additional capital buffers are needed. 5. Capital planning and management. Here are capital planning and management strategies. Earnings retention, retain profits to build capital reserves. Equity issuance, issue new shares to raise capital. Hybrid instruments, issue convertible bonds or preference shares. 6. Regulatory compliance. Basel III requirements, minimum Set 1, 4.5% of RWA. Minimum Tier 1 capital, 6% of RWA. Minimum total capital, 8% of RWA. Capital conservation buffer, additional 2.5% of RWA. Countercyclical buffer, up to 2.5% of RWA, as required. 7. Monitoring and reporting. It is essential to monitor capital levels and risk exposures and adjust capital strategies based on changes in risk profile and market conditions. Banks must report capital adequacy ratios to regulators and stakeholders to ensure transparency and compliance with disclosure requirements. 8. Analysis of capital adequacy. A. Financial stability. Adequate capital buffers ensure the bank can absorb losses and remain solvent during economic downturns. Risk management. Effective risk management practices enhance capital adequacy by reducing unexpected losses. B. Market confidence. Investor assurance. Strong CAR instills confidence among investors and depositors. Credit ratings. High capital adequacy positively impacts credit ratings, reducing borrowing costs. C. Economic impact. Lending capacity, adequate capital supports lending activities, fostering economic growth. Regulatory compliance, compliance with capital requirements avoids penalties and enhances operational resilience. Practical application and analysis of banks' capital adequacy involve calculating CAR, conducting stress tests, planning and managing capital, ensuring regulatory compliance, and continuous monitoring and reporting. By maintaining robust capital adequacy, banks can enhance financial stability, build market confidence, and support sustainable economic growth. These practices are essential for navigating regulatory landscapes, managing risks, and achieving long-term financial health. Impacts of regulatory changes on banks' capital adequacy. Regulatory changes significantly impact banks' capital adequacy, influencing how they manage their capital, allocate assets, and approach risk management. Regulatory frameworks such as Basel III have introduced stringent capital requirements, which aim to enhance banks' resilience but also pose challenges. Here is an in-depth analysis of how regulatory changes affect banks' capital adequacy. 1. Increased capital requirements. Basel III standards. Common Equity Tier 1, Set 1, ratio, raised from 2% to 4.5% of risk-weighted assets, RWA. Tier 1 capital ratio, increased to 6%. Total capital ratio, remains at 8%, but with stricter definitions of capital components. Implications. A. Capital buffers. Banks must hold additional capital buffers, such as the capital conservation buffer, 2.5%, and the countercyclical buffer, up to 2.5%. B. Quality of capital. Emphasis on higher quality capital, particularly Set 1, the most loss-absorbing form. 2. Enhanced risk coverage. Credit risk. Standardized approach. Enhanced risk weight calculations for various asset classes, leading to more accurate RWA. Internal ratings-based (IRB) approach. Banks using their models must meet higher validation standards. Market risk. Fundamental Review of the Trading Book, FRTB, introduces more rigorous capital requirements for market risk, including stress testing and internal model approval. Operational risk. Standardized Measurement Approach, SMA, replaces previous models with a standardized approach that increases capital charges for operational risk. 3. Leverage ratio. Leverage ratio, a non-risk-based measure set at a minimum of 3%, requiring banks to hold a minimum level of capital against total exposure. Implication. Balance sheet management forces banks to manage leverage more effectively, potentially leading to deleveraging or capital increases to meet the new requirements. 4. Liquidity requirements. Liquidity coverage ratio, LCR. Requirement: banks must hold sufficient high-quality liquid assets, HQLA, to cover net cash outflows for 30 days. Net stable funding ratio, NSFR. Requirement: ensures banks maintain a stable funding profile for their assets and off-balance sheet activities over 1 year. Implications. 1. Asset allocation. Banks may shift towards holding more liquid assets, impacting profitability due to lower yields on HQLA. 2. Funding strategies. Emphasis on stable funding sources to meet NSFR requirements, which affect the cost and availability of funding. 5. Macroprudential regulation. A. Systemically important financial institutions, SIFIs. Additional capital requirements. SIFIs are subject to higher capital buffers to mitigate systemic risk. B. Stress testing. Regulatory stress tests. Regular stress tests conducted by regulators to ensure banks can withstand economic shocks. Implications. 1. Capital buffers. SIFIs need to hold additional capital, which impacts their return on equity and requires more robust capital planning. 2. Risk management. Enhanced focus on comprehensive risk management practices to meet stress test requirements. 6. Regulatory reporting and transparency. Enhanced disclosure requirements. Pillar 3, Basel III mandates greater transparency in banks' capital adequacy and risk management practices. Implications. 1. Investor confidence. Improved transparency enhances market confidence and can lead to better funding conditions. 2. Operational costs. Increased reporting requirements add to operational costs, necessitating investment in systems and processes. 7. Implementation challenges. Regional variations. Jurisdictional differences. Implementation timelines and interpretations of Basel III can vary across regions, creating challenges for multinational banks. Implications. 1. Regulatory arbitrage. Banks may engage in regulatory arbitrage, shifting operations to jurisdictions with more favorable regulations. 2. Compliance costs. Higher compliance costs and complexity in managing differing regulatory requirements across jurisdictions. Regulatory changes to strengthen banks' capital adequacy profoundly impact their operations, risk management, and financial performance. While these regulations enhance financial stability and reduce the likelihood of systemic crises, they also present challenges in terms of higher capital requirements, increased compliance costs, and adjustments in asset allocation and funding strategies. Banks must navigate these changes strategically, balancing regulatory compliance with profitability and growth objectives to maintain robust capital adequacy and resilience in an evolving regulatory landscape. Identifying and measuring banks' risks. Banks face several risks that can affect their financial stability and performance. Identifying and accurately measuring these risks is crucial for effective risk management and regulatory compliance. Here is an overview of banks' critical risks and the methods used to measure them. 1. Credit risk. Credit risk is the risk of loss due to a borrower's failure to repay a loan or meet contractual obligations. Identification of credit risk. Loan portfolio analysis, assessing the quality of loans and advances. Credit ratings, using internal and external credit ratings to evaluate borrower risk. Default probability, estimating the likelihood of default based on borrower financials and macroeconomic conditions. Measurement of credit risk. Probability of default, PD, the likelihood that a borrower will default on their obligations. Loss given default, LGD, the portion of an exposure lost when a borrower defaults after accounting for recoveries. Exposure at default, EAD, the total value a bank is exposed to when a borrower defaults. Expected loss, L, calculated as L equals PD times LGD times ARD. 2. Market risk. Market risk is the risk of losses due to changes in market prices, including interest, foreign exchange, equity, and commodity prices. Identification of market risk. Trading book, analyzing positions held for short-term trading. Investment portfolio, assessing the impact of market movements on long-term investments. Measurement of market risk. Value at risk, VAR, a statistical technique that estimates a portfolio's potential loss in value over a defined period for a given confidence interval. Stress testing, simulating extreme market conditions to assess the impact on the bank's portfolio. Sensitivity analysis, measuring the impact of changes in market variables, for example, interest rate shifts, on the portfolio. 3. Operational risk. Operational risk is the risk of loss resulting from inadequate or failed internal processes, people, systems, or external events. Identification of operational risk. Risk and control self-assessment, RCSA, identifying potential operational risks through self-assessment by business units. Incident reporting, tracking and analyzing operational risk incidents and near misses. Key risk indicators, KRIs, monitoring metrics that signal potential risk events. Measurement of operational risk. Loss distribution approach, LDA, using historical loss data to model and quantify operational risk. Scenario analysis, assessing the impact of hypothetical adverse scenarios on operational risk. Operational risk capital charge, calculating capital requirements using standardized or advanced measurement approaches per regulatory guidelines. 4. Liquidity risk. Liquidity risk is the risk that a bank will be unable to meet its financial obligations as they come due without incurring unacceptable losses. Identification of liquidity risk. Liquidity gap analysis, comparing maturing assets and liabilities to identify potential liquidity shortfalls. Cash flow projections, forecasting future cash inflows and outflows. Measurement of liquidity risk. Liquidity coverage ratio, LCR, ensuring the bank holds sufficient high-quality liquid assets to cover net cash outflows for 30 days. Net stable funding ratio, NSFR, ensuring the bank has stable funding to support its assets over 1 year. 5. Interest rate risk. Interest rate risk is the risk of loss due to adverse movements in interest rates affecting the bank's income or the value of its assets and liabilities. Identification of interest rate risk. Repricing gap analysis, comparing the timing of rate changes for assets and liabilities. Duration analysis, assessing the sensitivity of asset and liability values to interest rate changes. Measurement of interest rate risk. Net interest margin, NIM, monitoring the difference between interest income and expense. Economic value of equity, EVE, assessing the impact of interest rate changes on the bank's net worth. Interest rate sensitivity, calculating the impact of interest rate shifts on earnings and capital. 6. Foreign exchange risk. Foreign exchange risk is the risk of loss due to fluctuations in currency exchange rates. Identification of foreign exchange risk. Currency exposure analysis, identifying positions in different currencies. Hedging strategies, assessing the effectiveness of hedging activities. Measurement of foreign exchange risk. Value at risk, VaR, for FX, estimating potential losses due to currency fluctuations. Position limits, monitoring and managing exposure limits for different currencies. 7. Compliance and legal risks. Compliance and legal risks are the risk of loss due to non-compliance with laws, regulations, or internal policies. Identification of compliance and legal risks. Regulatory audits, regular audits to ensure compliance with regulatory requirements. Policy reviews, assessing the adequacy and implementation of internal policies. Measurement of compliance and legal risks. Fines and penalties, tracking costs associated with non-compliance. Litigation reserves, estimating potential legal liabilities and setting aside reserves. Effective risk identification and measurement are crucial for banks to manage their exposures, maintain capital adequacy, and comply with regulatory requirements. Banks can gain a comprehensive understanding of their risk profile and implement appropriate risk management strategies by employing a combination of qualitative assessments and quantitative models. This holistic approach ensures financial stability and resilience in various internal and external challenges. Strategies to circumvent banking regulatory requirements. While regulatory requirements are designed to ensure the stability and integrity of the financial system, some banks might seek to circumvent these rules to gain a competitive edge or enhance profitability. It's important to note that such strategies can carry significant risks and legal implications. Here are some common strategies that banks might use to circumvent regulatory requirements, along with the associated risks and potential regulatory responses. 1. Regulatory arbitrage. Regulatory arbitrage involves exploiting differences in regulations across jurisdictions to minimize regulatory burdens. Regulatory arbitrage strategies. A. Shifting operations, relocating certain business activities to countries with less stringent regulations. B. booking trades in lighter regulated jurisdictions, conducting trades and booking them in jurisdictions with lower capital requirements or lax oversight. C. Capital structure optimization, designing complex capital structures to minimize regulatory capital requirements. Regulatory arbitrage risks. A. Regulatory crackdown, authorities may close loopholes, leading to legal and financial penalties. B. Reputation risk, perceived as engaging in unethical practices, potentially harming the bank's reputation. C. Increased systemic risk, reducing overall stability in the financial system. 2. Off-balance sheet activities. Off-balance sheet activities involve keeping certain assets or liabilities off the bank's balance sheet to avoid regulatory scrutiny. Strategies for off-balance sheet activities. A. Special purpose vehicles, SPVs, using SPVs to hold assets and liabilities, excluding them from regulatory capital calculations. B. Securitization, packaging loans into securities and selling them to investors, reducing on-balance sheet exposure. C. Derivatives, engaging in derivative transactions to manage risk exposures without reflecting the full extent of liabilities on the balance sheet. Risks associated with off-balance sheet activities. A. Lack of transparency, investors and regulators may not view the bank's risk exposures. B. Potential for hidden losses, off-balance sheet items can mask significant financial risks that may materialize unexpectedly. C. Regulatory response, regulators may enhance disclosure requirements and expand the scope of balance sheet regulations. 3. Complex financial instruments. Banks may create complex financial products to exploit regulatory gaps and minimize capital requirements. Complex financial instruments strategies. A. Structured products, developing products like collateralized debt obligations, CDOs, that still need to be fully captured by existing regulatory frameworks. B. Synthetic transactions, synthetic instruments replicate exposures without holding the assets. C. Hybrid instruments, issuing hybrid financial instruments that combine debt and equity characteristics to achieve favorable regulatory treatment. Risks of complex financial instruments. A. Valuation challenges, difficulty in accurately valuing complex instruments can lead to mispriced risks. B. Increased volatility, complex products may introduce significant volatility and risk into the financial system. C. Enhanced scrutiny, regulators may impose stricter rules on using and disclosing complex financial instruments. 4. Leverage and risk management. Banks might engage in practices that increase leverage and risk-taking while appearing to comply with regulatory requirements. Leverage and risk management strategies. A. Hidden leverage, using derivative transactions and off-balance sheet items to take on additional leverage not reflected in regulatory metrics. B. Risk-weight optimization, structuring portfolios to minimize risk-weighted assets, RWA, and reduce capital requirements. C. Underestimating risk, using internal models to underreport the risk of certain assets or portfolios. Risks associated with leverage and risk management. A. Financial instability, high leverage and mismanaged risk can lead to significant losses and potential bank failures. B. Regulatory backlash, regulators' increased focus on leverage and risk management could lead to stricter rules. C. Market confidence, loss of market confidence if the bank's actual risk profile is revealed. 5. Creative accounting practices. Employing accounting techniques to manipulate financial statements and regulatory capital figures. Strategies for creative accounting practices. A. Income smoothing, using accounting provisions and reserves to smooth income and earnings over time. B. Deferred recognition, delaying the recognition of losses or accelerating the recognition of revenues. C. Revaluation of assets, adjusting asset valuations to improve balance sheet metrics. Creative accounting practices risks. A. Regulatory sanctions, significant fines and penalties if creative accounting practices are discovered. B. Auditor scrutiny, increased scrutiny from auditors and potential restatements of financial results. C. Legal consequences, potential legal action from regulators, shareholders, and other stakeholders. 6. Intercompany transactions. Using transactions between affiliated entities to manipulate financial statements and regulatory capital. Intercompany transactions strategies. A. Transfer pricing, setting prices for transactions between related entities to shift profits to lower tax or lower regulation jurisdictions. B. Intra-group funding, using loans and guarantees within a group to manage regulatory capital. C. Circular transactions, creating circular structures to inflate asset values or earnings. Intercompany transactions risks. A. Tax authorities, increased scrutiny and potential disputes with tax authorities over transfer pricing practices. B. Regulatory crackdown, potential regulatory action to unwind or penalize manipulative intra-group transactions. C. Complexity and risk, increased complexity and interconnectedness within the group, potentially leading to systemic risks. While banks may employ various strategies to circumvent regulatory requirements, these practices can carry significant legal, financial, and reputational risks. Regulatory bodies continuously adapt and enhance their frameworks to close loopholes and ensure the stability and integrity of the financial system. Banks must balance the pursuit of regulatory arbitrage with the potential consequences and ethical considerations, ensuring their practices align with regulatory standards and broader societal expectations. Cost implications of circumventing banking regulatory requirements. Circumventing banking regulatory requirements can initially appear advantageous for financial institutions seeking to minimize compliance costs and maximize profits. However, these actions often come with significant cost implications, both direct and indirect. Let us analyze the costs. 1. Legal and regulatory costs. Penalties and fines. Immediate financial impact. Banks caught circumventing regulations can face hefty fines and penalties imposed by regulatory authorities. For instance, Deutsche Bank was fined $630 million in 2017 for involvement in a Russian money laundering scheme. Similarly, Wells Fargo was fined $185 million in 2016 for creating unauthorized customer accounts. Litigation costs. Legal fees, high costs associated with defending against lawsuits and regulatory actions. Settlement payments, significant financial settlements to resolve legal disputes and regulatory enforcement actions. Compliance remediation. Investments in compliance programs, increased spending on compliance programs to address regulatory deficiencies and prevent future violations. Consulting fees, hiring external consultants to review and overhaul compliance frameworks. 2. Operational costs. Reputational damage. Loss of customer trust. Customers may withdraw deposits or move their business to more reputable institutions, decreasing revenue. Brand damage. Negative publicity can tarnish the bank's brand, affecting its market position and customer loyalty. Increased scrutiny. Enhanced regulatory oversight. Banks that have circumvented regulations may face more stringent and frequent examinations by regulatory bodies. Operational disruptions. Increased scrutiny can disrupt normal operations, diverting resources towards compliance and regulatory matters. 3. Financial costs. Capital requirements. Higher capital buffers. Regulators may impose additional capital requirements on banks that have engaged in circumventing activities to ensure financial stability. Increased risk weightings, reclassification of assets and increased risk weightings, leading to higher capital charges. Liquidity constraints. Liquidity coverage ratio, LCR, adjustments. Stricter requirements for maintaining high-quality liquid assets impact the bank's liquidity position. Net stable funding ratio, NSFR, compliance, additional costs to meet long-term funding requirements. 4. Indirect costs. Market reaction. Stock price decline. Negative news related to regulatory circumvention can cause a bank's stock price to decline, affecting its market capitalization. Credit rating downgrade. Rating agencies may downgrade the bank's credit rating, increasing borrowing costs and reducing access to capital markets. Operational changes. Management time and focus. Senior management may need to spend considerable time addressing regulatory issues, detracting from strategic and operational priorities. Internal controls enhancement. Investing in more robust internal controls and risk management systems to prevent future regulatory breaches. 5. Long-term strategic costs. Loss of business opportunities. Restricted growth. Regulatory sanctions can limit banks' ability to expand or enter new markets. Regulatory restrictions. Potential restrictions on certain business activities, such as trading or proprietary investments. Employee morale and retention. Workforce impact. Regulatory issues can affect employee morale and retention, leading to higher turnover and recruitment costs. Talent attraction. Challenges in attracting top talent due to the bank's tarnished reputation. Case studies highlighting cost implications of circumventing banking regulatory requirements. 1. HSBC, 2012. Violation, lax controls leading to money laundering activities. Costs, $1.9 billion in fines and compliance costs, substantial investment in compliance infrastructure and personnel. Reputation, long-term damage to reputation and increased regulatory scrutiny. 2. Goldman Sachs, 1MDB scandal, 2020. Violation, involvement in the 1MDB scandal. Costs, over $5 billion in fines and settlements. Operational impact, increased regulatory oversight and significant reputational damage. 3. JP Morgan Chase, London Whale, 2013. Violation, inadequate risk management, leading to massive trading losses. Costs, $920 million in fines, enhanced regulatory requirements and internal controls. Market reaction, stock price impact and heightened regulatory scrutiny. Circumventing banking regulatory requirements can lead to significant short-term and long-term costs, encompassing legal, financial, operational, and strategic dimensions. These costs often outweigh the initial benefits of avoiding regulatory compliance. Banks must carefully weigh the potential advantages of circumventing regulations against the substantial risks and costs associated with such actions. Adopting a proactive and compliant approach mitigates these risks and contributes to long-term stability, reputation, and sustainable growth. Regulatory arbitrage and banks' compliance costs. 1. Regulatory arbitrage. Regulatory arbitrage occurs when banks exploit differences in regulatory frameworks across jurisdictions to reduce their regulatory burden or enhance profitability. It involves shifting activities to less regulated environments or using financial engineering to circumvent regulations. Examples of regulatory arbitrage. A. Cross-border transactions. Banks may move certain operations to countries with more lenient capital requirements or lower compliance costs. B. Structured products. Creating complex financial products not fully captured by existing regulations reduces the regulatory capital needed. C. Off-balance sheet activities, using special purpose vehicles, SPVs, or other off-balance sheet entities to keep certain assets and liabilities out of regulatory scrutiny. Impacts of regulatory arbitrage. A. Increased systemic risk. Regulatory arbitrage can undermine the effectiveness of regulations designed to ensure financial stability, potentially increasing systemic risk. B. Competitive disadvantage. Institutions adhering strictly to regulations may face a competitive disadvantage compared to those engaging in arbitrage. C. Regulatory response. Regulators may need to continually adapt and harmonize regulations to close loopholes and prevent arbitrage. 2. Banks' compliance costs. Compliance costs refer to the expenses banks incur to adhere to regulatory requirements. These costs include reporting, monitoring, internal controls, and personnel. Components of banks' compliance costs. A. Operational costs, investments in technology, systems, and processes to ensure compliance. B. Personnel costs, hiring compliance officers, legal experts, and risk managers. C. Training costs. Continuous training programs are needed so that staff stay updated with regulatory changes. D. Reporting costs. Costs associated with generating and submitting required regulatory reports. Examples of banks' compliance costs. A. Basel III requires banks to maintain higher capital ratios, leading to increased costs related to capital planning and risk management. B. Anti-money laundering, AML. Compliance with AML regulations involves significant investments in monitoring systems, customer due diligence, and reporting suspicious activities. C. Dodd-Frank Act, USA, introduces extensive reporting requirements and stress testing, increasing operational and administrative costs. D. General Data Protection Regulation, GDPR, EU. This regulation mandates data protection measures, which results in higher costs for data management and security. Impacts of banks' compliance costs. A. Financial performance. High compliance costs can impact a bank's profitability, especially smaller institutions with fewer resources to spread these costs. B. Innovation and growth. Banks may be hesitant to innovate or expand into new markets due to the high cost of compliance. C. Operational efficiency. Significant resources devoted to compliance can divert attention and investment from core banking activities, potentially affecting operational efficiency. Balancing compliance and regulatory arbitrage. 1. Harmonization of regulations. Global standards. Developing and enforcing global regulatory standards, for example, Basel III, to reduce opportunities for regulatory arbitrage. Cross-border coordination, enhancing cooperation among regulators to ensure consistent application of regulations across jurisdictions. 2. Enhanced supervisory practices. Regular audits, conducting frequent and thorough audits to ensure compliance and detect arbitrage activities. Data sharing, sharing information between regulatory bodies to monitor cross-border activities and prevent arbitrage. 3. Technology and innovation. RegTech solutions, investing in regulatory technology, RegTech, to automate compliance processes, reducing costs and improving efficiency. Advanced analytics, using advanced data analytics and AI to proactively detect potential arbitrage and compliance violations. 4. Risk-based approaches. Tailored regulations, implementing risk-based regulatory frameworks that adjust requirements based on the institution's size, complexity, and risk profile. Proportional compliance, allowing smaller banks to meet compliance requirements proportionally to their risk exposure and operational scale. 5. Internal policies and controls. Robust governance, establishing strong internal governance frameworks to ensure adherence to regulatory requirements and ethical standards. Training and culture, promoting a culture of compliance within the organization through continuous training and awareness programs. Regulatory arbitrage and compliance costs are critical issues in the banking sector, impacting financial stability and operational efficiency. While regulatory arbitrage can undermine regulatory objectives, high compliance costs constrain banks' resources. Balancing these aspects requires coordinated regulatory efforts, investment in technology, and robust internal controls to ensure compliance while maintaining competitiveness and innovation in the banking industry. Impacts of economic cycles and market conditions on banks' capital adequacy. Banks' capital adequacy is a critical factor in ensuring the stability and resilience of financial institutions. Economic cycles and market conditions influence banks' capital adequacy through various mechanisms. Let us explore how different phases of economic cycles and varying market conditions impact banks' capital adequacy. 1. Economic cycles. Economic cycles, consisting of periods of expansion and contraction, directly affect the financial health of banks. A. Expansion phase. During periods of economic growth, increased lending, banks typically see higher loan demand as businesses and consumers seek to capitalize on favorable economic conditions. This can lead to higher earnings and improved capital positions. Profitability. Higher economic activity generally leads to increased bank profitability through higher interest income and reduced default rates. Capital accumulation. Profitable operations enable banks to retain earnings, enhancing their capital base and capital adequacy ratios. Credit quality. Improved credit quality during expansions reduces the need for loan loss provisions, further supporting capital levels. B. Contraction phase. During economic downturns, loan defaults, higher default rates increase non-performing assets, necessitating higher loan loss provisions and reducing banks' profitability. Credit risk. Elevated credit risk during recessions can erode banks' capital say due to increased write-offs and provisions. Decreased lending, reduced demand for loans and higher risk aversion lead to lower income from lending activities. Capital erosion. Losses incurred during economic downturns can erode capital buffers, potentially breaching regulatory capital requirements. Regulatory pressure. Regulators may impose stricter capital requirements to ensure stability, further straining banks' capital adequacy. 2. Market conditions. Market conditions, including interest rates, financial market volatility, and liquidity, are crucial in determining banks' capital adequacy. A. Interest rates. Interest rates profoundly impact banks' capital adequacy as follows. Net interest margin, NIM, the difference between the interest income generated from loans and the interest paid on deposits and borrowings. Higher interest rates can improve NIM, enhancing profitability and capital levels. Loan demand. Lower interest rates typically stimulate borrowing, increasing loan portfolios and income. Conversely, higher rates can dampen loan demand. Asset valuations. Rising interest rates can negatively affect the market value of fixed income securities, potentially leading to losses on banks' investment portfolios. B. Financial market volatility. Market volatility can impact banks' capital adequacy through several channels, including trading losses. Increased market volatility can lead to significant trading losses, adversely affecting profitability and capital levels. Market risk. Higher volatility increases market risk, necessitating higher capital allocations to cover potential losses. Funding costs. Volatile markets can lead to higher funding costs and reduced access to capital markets, straining liquidity and capital positions. C. Liquidity conditions. Liquidity conditions in the financial markets influence banks' capital adequacy, including liquidity buffers. During periods of market stress, banks may need to hold higher liquidity buffers, reducing the available capital for lending and other profitable activities. Asset fire sales. In tight liquidity conditions, banks might be forced to sell assets at depressed prices, leading to capital losses. Regulatory requirements. Regulators may impose stricter liquidity requirements during financial stress, further impacting capital adequacy. 3. Regulatory and policy responses. Regulatory and policy measures can mitigate or exacerbate the impact of economic cycles and market conditions on banks' capital adequacy. A. Countercyclical capital buffers. Countercyclical capital buffers are designed to increase capital requirements during economic growth and relax them during downturns. This helps build capital buffers during good times that can be drawn down during bad times, smoothing the impact of economic cycles on capital adequacy. B. Stress testing. Regulators conduct stress tests to assess banks' resilience to adverse economic and market scenarios. Stress tests can identify potential capital shortfalls and prompt preemptive capital raising or risk mitigation measures. C. Monetary policy. Interest rates. Central banks' interest rate policies directly affect banks' profitability and capital levels. Liquidity support. Central banks can provide liquidity support during market stress, alleviating pressures on banks' capital adequacy. Case studies. 1. Global financial crisis, 2007 to 2009. Impact: massive loan defaults and trading losses eroded banks' capital levels, leading to significant bailouts and stricter regulatory reforms. Regulatory response: introduction of Basel III regulations, increasing capital and liquidity requirements to enhance banks' resilience. 2. COVID-19 pandemic, 2020. Impact: economic contraction led to higher loan defaults and increased provisions, straining banks' capital adequacy. Regulatory response: temporary easing of capital and liquidity requirements to support lending and economic recovery. Economic cycles and market conditions profoundly impact banks' capital adequacy. Banks generally experience improved profitability and capital accumulation during expansions, while contractions can lead to higher defaults and capital erosion. Market conditions, such as interest rates and liquidity, further influence banks' capital positions. Regulatory measures, such as counter-cyclical capital buffers and stress testing, are crucial in mitigating these impacts and ensuring the banking system's stability. Understanding these dynamics is essential for banks to effectively manage their capital adequacy and maintain resilience in economic and market fluctuations. Challenges in maintaining capital adequacy. Maintaining capital adequacy ratios, CAR, poses several challenges for banks, which are crucial to address to ensure financial stability, regulatory compliance, and sustainable operations. Here are some of the key challenges. 1. Economic and market volatility. Economic downturns or financial turbulence can increase credit defaults, market risk, and liquidity pressures. Banks may experience sudden declines in asset values or increased risk-weighted assets, RWA, necessitating additional capital buffers to maintain adequate CAR. 2. Cost of capital. Raising additional capital can be costly, particularly during economic stress or unfavorable market conditions. Higher borrowing costs or equity issuance expenses can erode profitability and limit banks' ability to maintain optimal CAR levels. 3. Asset quality and risk management. Poor loan quality, concentration risks, or inadequate risk management practices can increase credit risk and impair asset performance. Banks may need to allocate more capital to cover potential losses, reducing CAR and constraining lending capacity. 4. Regulatory changes and compliance. Evolving regulatory requirements, such as updates to Basel III or local regulatory frameworks, increase minimum CAR thresholds or introduce new capital buffers. Banks must continually adapt capital management strategies and operational processes to comply with these resource-intensive and complex regulatory standards. 5. Business growth and expansion. Strategic initiatives for business growth, mergers, or acquisitions can increase risk exposures and require additional capital allocation. Balancing growth objectives with adequate CAR levels requires careful capital planning and risk assessment to avoid overextension or regulatory scrutiny. 6. Profitability pressures. Low interest rates, competitive pressures, or economic downturns can squeeze net interest margins and profitability. Banks may need help generating sufficient earnings to support capital adequacy, potentially limiting their ability to retain earnings for capital accumulation. 7. Internal capital allocation and management. Allocating capital efficiently across business lines, products, and geographic regions while optimizing returns and managing risk can be complex. Inadequate capital allocation strategies may lead to suboptimal resource use and difficulty maintaining balanced CAR levels across the organization. 8. Technological and operational risks. Cybersecurity threats, operational disruptions, or technological innovations can introduce new risks that may impact financial stability and capital adequacy. Investing in robust IT infrastructure and operational resilience measures is essential to mitigate risks and ensure continuous compliance with CAR requirements. To address these challenges effectively, banks can implement the following strategies. 1. Stress testing. Conduct regular stress tests to assess the impact of adverse economic scenarios on CAR and capital buffers. 2. Enhanced risk management, strengthening credit risk assessment, liquidity management, and operational controls to mitigate risks and preserve capital. 3. Optimized capital planning, developing robust capital planning frameworks that align with business strategies and regulatory requirements. 4. Cost efficiency measures, implementing cost-cutting initiatives and optimizing operational efficiencies to preserve earnings and support capital accumulation. 5. Continuous monitoring and reporting, establishing robust monitoring mechanisms and timely reporting to ensure transparency and compliance with regulatory standards. By proactively addressing these challenges and adopting prudent capital management practices, banks can enhance their resilience, maintain adequate CAR levels, and sustain long-term financial health amid evolving market dynamics and regulatory landscapes. Challenges and criticisms of capital adequacy regulations. Capital adequacy regulations, CAR, are essential for maintaining financial stability and ensuring banks have sufficient buffers to absorb potential losses. However, they also face several challenges and criticisms, which are crucial to consider. Challenges of capital adequacy regulations. 1. Complexity and compliance costs. CAR frameworks, such as Basel III, are complex and require banks to allocate significant resources to comply with regulatory requirements. Small and medium-sized banks may struggle with compliance costs, potentially reducing profitability or limited lending capacity. 2. Procyclicality. CAR calculations can exacerbate economic cycles by reinforcing credit contraction during downturns and expansion during upturns. This can amplify financial instability and hinder economic recovery efforts during economic stress. 3. Risk sensitivity and calibration. Risk-weighted assets, RWA, calculations may not always accurately reflect the actual risk profile of assets, leading to discrepancies in capital requirements. Banks may misallocate capital or engage in regulatory arbitrage to optimize CAR ratios, undermining the effectiveness of risk management. 4. International variability. CAR standards and implementation can vary across jurisdictions, leading to regulatory arbitrage and inconsistencies in global financial regulation. Banks operating in multiple jurisdictions must comply with diverse regulatory requirements, complicating cross-border operations. 5. Impact on lending and economic growth. Stringent CAR requirements may restrict banks' capacity to extend credit, particularly during economic downturns when credit availability is critical. Reduced lending can impede economic growth and job creation, affecting economic stability and prosperity. Criticisms of capital adequacy regulations. 1. Insufficient capital requirements. Some argue that minimum CAR thresholds set by regulators are inadequate to withstand severe economic shocks or systemic crises. Banks may not hold enough capital to absorb significant losses, posing risks to depositors and requiring taxpayer-funded bailouts. 2. Procyclicality and economic impact. CAR exacerbates economic cycles by amplifying credit contractions during downturns and potentially fueling excessive lending during upturns. This can destabilize financial markets and undermine sustainable economic growth and stability efforts. 3. Complexity and inefficiency. CAR frameworks are overly complex and may not effectively capture all risks, such as operational or systemic risks. Banks may focus on regulatory compliance rather than limited aspects of risk management, leading to inefficiencies and reduced effectiveness in safeguarding financial stability. 4. Capital arbitrage and regulatory capture. Banks may use capital arbitrage strategies to manipulate CAR ratios or influence regulatory decisions. This behavior can distort risk assessment and capital allocation, undermining the integrity and purpose of CAR regulations. 5. Impact on competition. Large banks with greater access to capital markets may have a competitive advantage over smaller banks, which struggle to meet stringent CAR requirements. This can lead to market concentration and reduced competition, limiting consumer choice and innovation in financial services. While capital adequacy regulations are essential for promoting financial stability and protecting depositors, they face significant challenges and criticisms related to complexity, pro-cyclicality, international variability, and economic impact. Addressing these issues requires ongoing evaluation, adjustments to regulatory frameworks, and balancing regulatory objectives with the need for sustainable economic growth and financial resilience. Regulatory authorities must continue to refine CAR frameworks to enhance effectiveness, reduce regulatory arbitrage, and promote a resilient and competitive banking sector. Future developments and trends in banks' capital adequacy. Several future developments and trends are expected to shape the landscape of banks' capital adequacy ratios, CAR, influenced by regulatory changes, technological advancements, and evolving market dynamics. Here are some key areas to consider. 1. Enhanced risk sensitivity. Advanced risk measurement, continued risk modeling and data analytics advancements will improve the accuracy and granularity of risk assessments. Dynamic adjustments. Banks are increasingly moving towards more dynamic risk adjustments, such as incorporating macroeconomic factors and forward-looking measures into risk-weighted assets, RWA, calculations. Real-time monitoring. Adopting real-time monitoring tools to assess risk exposures and adjust capital adequacy promptly. 2. Integration of environmental, social, and governance, ESG, factors. ESG risk integration, incorporating ESG considerations into risk management frameworks and capital allocation decisions. Climate risk assessment, developing methodologies to quantify and manage climate-related risks, influencing capital adequacy requirements. Regulatory expectations. There is an increasing focus on ESG factors, which could lead to specific capital adequacy requirements related to sustainability risks. 3. Digital transformation. Fintech integration, collaboration with fintech firms to enhance risk assessment capabilities and operational efficiencies. Blockchain and distributed ledger technology, exploring applications of blockchain for real-time auditing and transaction verification, impacting capital adequacy reporting. Cybersecurity enhancements, strengthening cybersecurity measures to protect against data breaches and operational risks affecting capital adequacy. 4. Regulatory reforms and harmonization. Basel IV considerations, potential revisions to Basel III, including adjustments to capital requirements, buffers, and leverage ratios. Global alignment, efforts towards global regulatory harmonization to mitigate regulatory arbitrage and enhance consistency in capital adequacy standards. Supervisory practices, enhanced supervisory practices focusing on risk culture, governance, and transparency in capital adequacy reporting. 5. Capital management strategies. Capital optimization, continued focus on optimizing capital structures and funding strategies to meet regulatory requirements efficiently. Stress testing and scenario analysis, expansion of stress testing scenarios to incorporate extreme events and systemic risks, influencing capital adequacy planning. Diversification and innovation, exploring innovative capital instruments and diversification strategies to enhance capital resilience and flexibility. 6. Market dynamics and economic conditions. Economic uncertainty, adapting capital adequacy frameworks to withstand economic shocks and prolonged periods of low interest rates. Credit cycle management, implementing strategies to manage credit cycles effectively, balancing lending growth with risk appetite and capital adequacy. Impact of global events, assessing the impact of geopolitical events, trade tensions, and pandemics on capital adequacy and financial stability. Technological innovation, regulatory reforms, and evolving market dynamics will shape the future of banks' capital adequacy ratios, CAR. To maintain robust capital adequacy positions, banks must adapt by enhancing risk sensitivity, integrating ESG considerations, embracing digital transformation, and optimizing capital management strategies. Regulatory alignment and proactive risk management will be crucial in navigating future challenges and opportunities in the global banking sector. Roles of technological advancements on banks' capital adequacy. Technological advancements profoundly impact banks' capital adequacy by influencing risk management, operational efficiency, compliance, and customer engagement. Let us discuss how these advancements shape banks' capital adequacy. 1. Enhanced risk management. A. Data analytics and big data. Improved risk assessment. Advanced data analytics enable banks to analyze large volumes of data to identify risk patterns and trends. This helps in more accurate credit risk assessment, reducing the probability of loan defaults. Predictive modeling. Big data allows banks to use predictive models to forecast potential risks and take preemptive actions, thereby safeguarding their capital. B. Artificial intelligence, AI, and machine learning, ML. Fraud detection. AI and ML algorithms can quickly detect fraudulent activities to reduce financial losses and protect capital. Credit scoring. AI-driven credit scoring models provide more accurate assessments of borrowers' creditworthiness, improving loan portfolio quality and capital adequacy. C. Blockchain technology. Secure transactions. Blockchain ensures secure and transparent transactions, reducing the risk of fraud and operational errors. Smart contracts. Automated execution of contracts on blockchain platforms reduces counterparty risk, enhancing overall risk management. 2. Operational efficiency. A. Automation and robotics. Process automation. Robotic process automation, RPA, automates repetitive tasks, reducing operational costs and increasing efficiency. This can lead to higher profitability and improved capital ratios. Cost reduction. Automation reduces the need for manual interventions, cutting down operational expenses and improving the bottom line. B. Cloud computing. Scalability. Cloud solutions offer scalable infrastructure, reducing the need for large capital expenditures on information technology, IT, infrastructure. Cost efficiency. Cloud computing reduces IT maintenance costs, allowing banks to allocate more resources towards capital reserves. 3. Regulatory compliance. A. RegTech, regulatory technology. Compliance automation. RegTech solutions automate compliance processes, ensuring timely and accurate reporting to regulators. This reduces the risk of non-compliance penalties that can erode capital. Real-time monitoring. Advanced RegTech tools provide real-time monitoring of regulatory changes and compliance status, helping banks stay ahead of regulatory requirements. B. Enhanced reporting and transparency. Improved data management. Technology enhances data management capabilities, enabling more accurate and timely regulatory reporting. Transparency. Better transparency and accurate reporting reduce the likelihood of regulatory scrutiny and associated fines. 4. Customer engagement and revenue generation. A. Digital banking. Increased reach. Digital banking platforms enable banks to reach a broader customer base, increasing deposits and lending opportunities. Customer insights. Advanced analytics provide insights into customer behavior, enabling personalized services that enhance customer satisfaction and loyalty. B. Fintech integration. Innovative products. Collaboration with fintech firms allows banks to offer innovative financial products and services, attracting more customers and increasing revenue. Efficiency gains. Fintech solutions streamline various banking operations, reducing costs and improving profitability. 5. Cybersecurity. A. Advanced security measures. AI-powered security. AI and ML enhance cybersecurity measures, protecting banks from cyber threats and financial losses that can impact capital adequacy. Real-time threat detection. Technologies like behavioral analytics detect and mitigate threats in real time, ensuring the integrity of financial transactions. B. Risk mitigation. Resilience. Robust cybersecurity frameworks ensure operational resilience, preventing financial disruptions that can lead to capital erosion. Compliance. Adherence to cybersecurity regulations reduces the risk of fines and penalties. 6. Capital optimization. A. Advanced financial modeling. Stress testing. Advanced simulation tools allow banks to conduct more rigorous stress testing, ensuring they maintain adequate capital buffers under various economic scenarios. Scenario analysis. Technology enables detailed scenario analysis, helping banks optimize their capital allocation and maintain regulatory compliance. B. Portfolio management. Optimization algorithms. AI-driven optimization algorithms improve portfolio management, enhancing returns and capital adequacy. Risk diversification. Technology facilitates better risk diversification strategies, reducing the overall risk exposure of the bank. Case studies. 1. JP Morgan Chase. AI and Big Data. JP Morgan Chase uses AI and big data analytics to enhance risk management and operational efficiency. This has contributed to better credit risk assessment and lower default rates. Blockchain. The bank's adoption of blockchain technology for transaction processing has reduced operational risks and enhanced transparency. 2. BBVA. RegTech adoption. BBVA leverages RegTech solutions to automate compliance processes, ensuring timely and accurate reporting to regulators and reducing the risk of penalties. Digital banking. BBVA's digital transformation has expanded its customer base, increased deposits, and improved revenue, contributing to better capital adequacy. 3. Goldman Sachs. Cloud computing. Goldman Sachs uses cloud computing to scale its operations efficiently, reducing IT costs and improving overall profitability. Cybersecurity. The bank's investment in advanced cybersecurity measures safeguards its capital against financial losses from cyber threats. Technological advancements are critical in enhancing banks' capital adequacy by improving risk management, operational efficiency, regulatory compliance, customer engagement, and cybersecurity. By leveraging these technologies, banks can optimize their capital allocation, reduce risks, and enhance profitability, ensuring they maintain robust capital adequacy ratios in varying economic and market conditions. Adopting and integrating these technological solutions is essential for banks to remain competitive and resilient in the ever-evolving financial landscape. Strategies for banks to improve capital adequacy. Banks must improve capital adequacy to enhance financial stability, meet regulatory requirements, and maintain investor and depositor confidence. Here are strategies banks can employ to enhance their capital adequacy ratios. 1. Earnings retention. Dividend policies. Adjusting dividend payout policies to retain a higher proportion of earnings can help bolster capital reserves. This may involve reducing dividend payouts during financial uncertainty or when capital adequacy needs to be strengthened. Profit reinvestment. Returning profits to the bank rather than distributing them to shareholders increases retained earnings, directly enhancing Tier 1 capital. 2. Capital raising. Equity issuance. Issuing new shares through public offerings or private placements can raise substantial capital. This method is straightforward but can dilute existing shareholders' equity. Hybrid instruments. Issuing hybrid capital instruments such as convertible bonds or preference shares that qualify as additional Tier 1, AT1, or Tier 2 capital can provide a flexible approach to bolstering overall capital. Subordinated debt. Raising capital through subordinated debt can enhance Tier 2 capital. While this does not affect Tier 1 capital, it strengthens the overall capital base. 3. Risk management enhancements. Credit risk management. Improving credit risk management practices by using advanced risk assessment models, enhancing credit underwriting standards, and monitoring loan performance can reduce non-performing assets, NPAs, and loan losses. Diversification. Diversifying the loan portfolio across different sectors, geographies, and customer segments can mitigate concentration risks and stabilize returns, improving overall capital adequacy. Hedging strategies. Financial derivatives and other hedging techniques can protect the bank's capital base from adverse movements by managing interest rates, currency, and other market risks. 4. Asset and liability management. Balance sheet optimization involves optimizing the asset and liability mix to reduce risk-weighted assets, RWA, without compromising returns. This may include shifting towards lower-risk assets or securitizing certain types of loans. Liquidity management. Maintaining high levels of liquidity to meet regulatory requirements and ensure the bank can withstand short-term funding pressures without depleting capital. 5. Operational efficiency. Cost reduction. Implementing cost-cutting measures to improve the cost-to-income ratio. Reducing operational costs can help preserve earnings and, in turn, strengthen retained earnings and capital adequacy. Digital transformation. Digital transformation involves investing in technology to enhance operational efficiency, reduce costs, and improve risk management. Digital banking, automation, and data analytics can contribute to better resource allocation and capital management. 6. Regulatory capital planning. Stress testing. Conduct regular stress tests to evaluate the impact of adverse economic scenarios on the bank's capital adequacy. This helps identify vulnerabilities and plan for capital needs accordingly. Regulatory compliance. Staying ahead of regulatory changes and ensuring compliance with evolving capital requirements. Proactive engagement with regulators and adopting best practices can prevent unexpected capital shortfalls. 7. Strategic business adjustments. Product mix optimization, focusing on high-margin, low-risk products that contribute positively to capital adequacy. This involves strategic shifts in the product portfolio to balance profitability and risk. Geographical diversification, expanding operations into regions with lower regulatory capital requirements or favorable economic conditions can improve overall capital efficiency. 8. Shareholder and market communication. Transparency, maintaining transparent communication with shareholders and the market about capital adequacy strategies, financial performance, and risk management practices. Transparency fosters trust and can support capital raising efforts. Investor relations, strengthening investor relations to build confidence and attract long-term investment. Engaged and informed investors are more likely to support capital raising initiatives. Improving capital adequacy is a multifaceted endeavor requiring strategic, operational, and financial measures. Banks can bolster their capital adequacy ratios by focusing on earnings retention, capital raising, risk management enhancements, balance sheet optimization, operational efficiency, regulatory compliance, strategic business adjustments, and transparent communication. These efforts will ensure regulatory compliance, enhance the bank's resilience against economic downturns, improve market confidence, and support sustainable growth. Implications of capital adequacy for banks. Capital adequacy is a critical aspect of banking regulation and financial management, with significant implications for banks' operations, risk management, profitability, and overall stability. Here are the key implications of capital adequacy for banks. 1. Financial stability. Buffer against losses. Adequate capital buffers protect banks from unexpected losses, ensuring they remain solvent and able to meet financial obligations even during adverse economic conditions. Systemic stability. Banks with sufficient capital contribute to overall financial system stability by reducing the risk of failures that could trigger broader economic instability. 2. Risk management. Credit risk. Capital adequacy frameworks require banks to hold capital proportional to the riskiness of their assets, encouraging prudent lending practices and mitigating credit risk. Market risk. Capital requirements for market risk ensure banks have sufficient funds to cover potential losses from fluctuations in interest rates, exchange rates, and asset prices. Operational risk. Adequate capital supports robust operational risk management, including investments in technology, cybersecurity, and contingency planning. 3. Regulatory compliance. Regulatory standards. Banks must comply with capital adequacy regulations like Basel III to operate legally and maintain regulatory approval. Capital ratios. Banks must regularly report capital adequacy ratios to regulatory authorities to demonstrate compliance and avoid penalties for non-compliance. 4. Profitability and growth. Cost of capital. Maintaining adequate capital can impact banks' cost of capital and funding costs. Higher capital ratios may lead to lower funding costs as investors perceive lower risk. Lending capacity. Adequate capitalization supports banks' ability to lend and invest, facilitating economic growth by financing businesses and individuals. 5. Market perception and investor confidence. Investor confidence. High capital adequacy ratios enhance investor confidence by signaling financial strength and risk management capabilities. Market competitiveness. Banks with strong capital positions may have a competitive advantage in attracting deposits, accessing capital markets, and acquiring other financial institutions. 6. Dividend policy and capital allocation. Dividend payments. Capital adequacy influences banks' dividend policies, as regulatory requirements may restrict dividend payments if capital levels fall below minimum thresholds. Capital allocation. Banks must balance capital allocation between dividends, reinvestment in business operations, and maintaining adequate reserves for growth and risk management. 7. Operational flexibility. Business strategy. Adequate capital allows banks to pursue strategic initiatives, such as mergers and acquisitions, without compromising regulatory compliance or financial stability. Crisis management. During financial crises or economic downturns, banks with strong capital positions have more options for navigating challenges and supporting recovery efforts. Capital adequacy is not just a regulatory requirement but a fundamental aspect of banks' financial health and risk management. It underpins financial stability, regulatory compliance, profitability, and investor confidence. Banks must continually assess and manage their capital adequacy to navigate dynamic market conditions, regulatory changes, and economic uncertainties while maintaining resilience and sustainability in the long term. Implications of capital adequacy for banking regulators. Capital adequacy is a cornerstone of banking regulation, with profound implications for regulators tasked with overseeing the stability and soundness of financial institutions. Here are the critical impacts of capital adequacy for banking regulators. 1. Financial stability. Systemic resilience. Capital adequacy requirements ensure banks have sufficient buffers to absorb losses and maintain solvency during economic downturns or financial crises. Systemic risk mitigation, regulators use capital adequacy standards to mitigate systemic risks by ensuring banks are adequately capitalized to withstand shocks and prevent contagion effects. 2. Risk management and supervision. Risk-based regulation, capital adequacy frameworks, such as Basel III, implement risk-based capital requirements that align capital levels with banks' risk exposures, credit, market, operational. Supervisory oversight, regulators monitor banks' capital adequacy ratios to assess risk management practices, enforce compliance with regulatory standards, and intervene proactively if capital levels are insufficient. 3. Regulatory compliance. Legal requirements. Banks must comply with capital adequacy regulations mandated by regulatory authorities to operate legally and maintain their banking licenses. Reporting and transparency. Banks must report capital adequacy ratios and financial conditions transparently to regulators, enabling effective supervision and oversight. 4. Crisis management and resolution. Early warning signals. Capital adequacy ratios serve as early warning indicators of financial distress or potential bank failures, prompting regulatory intervention to prevent systemic disruptions. Resolution planning. Regulators use capital adequacy assessments in resolution planning frameworks to ensure the orderly resolution of failing banks without taxpayer bailouts. 5. Market confidence and investor protection. Market stability. Regulators enforce capital adequacy requirements to enhance market confidence and stability and reduce the likelihood of financial market disruptions. Investor protection. Strong capital standards protect depositors and investors by minimizing the risk of bank failures and fund loss. 6. Global coordination and harmonization. International standards. Basel Committee on Banking Supervision sets global standards for capital adequacy, promoting consistency and comparability across jurisdictions. Cross-border supervision. Consistent capital adequacy frameworks facilitate cross-border supervision and coordination among regulatory authorities to address global financial risks. 7. Adaptability to changing risks. Risk management evolution. Regulators continuously update capital adequacy frameworks to address emerging risks, technological advancements, and evolving market conditions. Stress testing. Regulators conduct stress tests to assess banks' resilience under adverse scenarios, guiding adjustments to capital adequacy requirements as needed. Capital adequacy is crucial for banking regulators to promote financial stability, enhance risk management, and safeguard investor confidence. By enforcing rigorous capital standards, regulators mitigate systemic risks, ensure banks can absorb losses and maintain the financial system's integrity. Continuous monitoring, adaptation to evolving risks, and international cooperation are essential for effective regulation and supervision of capital adequacy in the global banking sector. Implications of capital adequacy for banks' customers. Capital adequacy in banks has several implications for customers, influencing their trust, financial security, and overall banking experience. Here are the critical implications. 1. Financial stability and safety. Depositor protection. Adequate capital ensures that banks can honor deposit withdrawals even during financial downturns or crises, assuring depositors about the safety of their funds. Reduced risk of bank failure. Higher capital buffers minimize the likelihood of bank failures, mitigating the risk of deposit losses for customers. 2. Credit availability and cost. Lending capacity. Well-capitalized banks are more likely to have the capacity to lend to businesses and individuals, supporting economic growth and providing access to credit. Competitive loan terms. Strong capital positions may enable banks to offer competitive interest rates and loan terms, which can benefit borrowers. 3. Service continuity. Operational resilience. Capital adequacy supports banks' operational resilience, ensuring the continuity of banking services even during economic disruptions or operational challenges. Customer service. Stable financial health allows banks to invest in customer service improvements, enhancing overall customer satisfaction. 4. Impact on products and services. Innovation and expansion. Banks with sufficient capital may have the resources to invest in new products, technology upgrades, and expanded service offerings, providing customers with more choices and improved banking experiences. Technology investments. Capital adequacy facilitates investments in digital banking platforms, cybersecurity measures, and customer-focused technologies, enhancing convenience and security for customers. 5. Regulatory compliance and transparency. Customer confidence. Regulatory compliance with capital adequacy requirements enhances customer confidence in banks' financial stability and governance practices. Transparency. Banks must disclose their capital adequacy ratios and financial health, which provides customers with transparency and enables informed banking decisions. 6. Risk management practices. Risk mitigation. Capital adequacy frameworks encourage banks to implement robust risk management practices, such as stringent credit assessments and diversified lending portfolios, reducing the risk of loan defaults and financial losses. Customer protection. Effective risk management protects customers' interests by ensuring responsible lending practices and safeguarding against operational and market risks. 7. Market perception and reputation. Brand reputation. Banks with strong capital positions and effective risk management practices enhance their reputation in the market, attracting more customers and fostering long-term relationships. Stakeholder trust. Capital adequacy builds trust among stakeholders, including customers, investors, and regulators, who perceive the bank as financially sound and trustworthy. Capital adequacy is crucial for banks' customers as it ensures financial stability, safety of deposits, access to credit, and continuity of banking services. Customers benefit from banks' strong capital positions through competitive products, improved service quality, and enhanced trust. Regulatory compliance and effective risk management practices further protect customers' interests and contribute to a positive banking experience. Therefore, customers should consider banks' capital adequacy and financial health when making banking decisions to safeguard their financial interests and ensure a reliable banking relationship. Implications of banks' capital adequacy for the broader financial system. Capital adequacy in banks plays a crucial role in maintaining financial stability and resilience within the broader financial system. Here are the critical implications of banks' capital adequacy. 1. Systemic stability. Risk absorption. Adequate capital buffers enable banks to absorb losses without jeopardizing their solvency or triggering financial contagion that could destabilize the entire financial system. Reduced systemic risk. Strong capital positions reduce the likelihood of bank failures, which can have systemic repercussions, affecting other financial institutions, markets, and the economy as a whole. 2. Credit availability and economic growth. Lending capacity. Well-capitalized banks can lend to businesses and individuals, supporting economic growth through investments, consumption, and job creation. Financial intermediation. Banks play a critical role in intermediating funds between savers and borrowers, facilitating efficient allocation of capital in the economy. 3. Market confidence and investor trust. Market stability. Capital adequacy requirements enhance market confidence by signaling banks' financial strength, risk management capabilities, and ability to withstand adverse economic conditions. Investor trust. Investors, including depositors, bondholders, and shareholders, place greater trust in banks with strong capital positions, reducing the cost of capital and improving access to funding. 4. Regulatory oversight and compliance. Regulatory framework. Capital adequacy regulations, such as Basel III, establish minimum capital standards and frameworks for risk management, ensuring banks operate prudently and maintain financial stability. Supervisory oversight. Regulators monitor banks' capital adequacy ratios and risk exposures to enforce compliance with regulatory standards and intervene when necessary to mitigate systemic risks. 5. Financial resilience during crises. Crisis management. Banks with sufficient capital buffers are better prepared to navigate financial crises, such as market downturns, credit crunches, or external shocks, maintaining stability and supporting economic recovery efforts. Systemic support. Strongly capitalized banks can stabilize the financial system by lending and supporting liquidity, mitigating the impact of crises on businesses and households. 6. International coordination and harmonization. Global standards. International coordination through frameworks like the Basel Accords ensures consistency in capital adequacy standards across jurisdictions, promoting financial stability on a global scale. Cross-border stability. Consistent capital adequacy requirements facilitate cross-border supervision and cooperation among regulatory authorities, enhancing resilience against global financial risks. 7. Risk management and contingency planning. Risk mitigation. Capital adequacy frameworks incentivize banks to adopt robust risk management practices, including asset diversification, stress testing, and contingency planning, to mitigate risks and protect capital. Resolution preparedness. Banks' capital adequacy assessments inform resolution planning frameworks, ensuring orderly resolution of failing institutions without systemic disruptions or taxpayer bailouts. Capital adequacy in banks is essential for maintaining financial stability, supporting economic growth, and enhancing investor confidence within the broader financial system. Regulators mitigate systemic risks by ensuring banks maintain sufficient capital buffers, protect depositors and investors, and promote sustainable economic development. Continuous oversight, adherence to regulatory standards, and effective risk management practices are critical in safeguarding the resilience and stability of the financial system amid evolving market dynamics and global challenges. Capital adequacy and banks' profitability. Capital adequacy and profitability are closely linked in the banking sector. Capital adequacy ensures that banks have enough capital to absorb losses and support stability, while profitability reflects a bank's ability to generate earnings and sustain operations. Let us examine the relationship between capital adequacy and profitability, exploring how these elements influence each other and their impact on overall bank performance. 1. The interrelationship between capital adequacy and profitability. A. Regulatory compliance and capital adequacy. Minimum capital requirements. Regulatory frameworks like Basel III require banks to maintain specific capital ratios, CET1, Tier 1, and total capital ratios. Compliance with these regulations ensures financial stability but may impact profitability due to capital holding costs. Capital buffers. Additional capital buffers, for example, capital conservation buffer, further ensure that banks can withstand economic shocks. While these buffers enhance stability, they also require more capital, affecting profitability. B. Profitability as a source of capital. Retained earnings. Profits retained within the bank contribute to capital accumulation, directly affecting capital adequacy ratios. Higher profitability allows banks to build capital reserves organically without raising external capital. Dividend policies. Decisions on dividend payouts versus retained earnings impact the capital available. Banks with higher profitability can balance rewarding shareholders and maintaining robust capital levels. 2. Impact of capital adequacy on profitability. A. Cost of capital. Equity versus debt. Higher capital adequacy ratios typically involve maintaining more equity capital. Since equity is more expensive than debt, the cost of maintaining high capital adequacy can reduce profitability. Return on equity, ROE. high capital ratios can dilute ROE, as the same level of profits is spread over a larger capital base. However, this can be mitigated by efficient capital management and risk-adjusted returns. B. Risk management and loss absorption. Enhanced stability. Adequate capital buffers improve a bank's ability to absorb losses, reducing the likelihood of financial distress and preserving long-term profitability. Credit ratings. Strong capital adequacy can lead to better credit ratings, reducing funding costs and enhancing profitability through cheaper access to capital markets. 3. Impact of profitability on capital adequacy. A. Earnings retention and capital growth. Organic capital growth. Profitable banks can retain earnings to build capital, enhancing their capital adequacy ratios without needing external capital injections. Investment in risk management. Higher profitability allows banks to invest in advanced risk management systems, improving asset quality and reducing the capital required for potential losses. B. Strategic flexibility. Growth and expansion. Profitable banks can pursue growth opportunities, such as mergers and acquisitions, while maintaining capital adequacy. Innovation and technology. Profitability enables investments in technology and innovation, improving operational efficiency and risk management and indirectly supporting capital adequacy. 4. Balancing capital adequacy and profitability. A. Efficient capital management. Optimal capital structure. Banks must balance holding sufficient capital for regulatory compliance and profitability. This involves optimizing the mix of equity, debt, and retained earnings. Risk-adjusted return. Banks should focus on risk-adjusted returns to ensure that higher capital adequacy does not significantly compromise profitability. B. Regulatory adaptation. Proactive compliance. Staying ahead of regulatory changes and maintaining robust capital planning processes can help banks adapt to new requirements without severely impacting profitability. Internal stress testing. Conducting regular internal stress tests helps banks assess potential impacts on capital adequacy and profitability, allowing for preemptive adjustments. 5. Case studies and empirical evidence. A. Historical analysis. Financial crises. Analysis of banks during financial crises, for example, the 2008 global financial crisis, shows that those with higher capital adequacy ratios fared better regarding stability and long-term profitability. Regulatory changes. Empirical studies indicate that stricter capital requirements initially reduce profitability due to higher costs but lead to more stable earnings and reduced risk in the long run. B. Comparative studies. Regional differences. Comparative studies across regions with different regulatory frameworks provide insights into how capital adequacy influences profitability under varying economic conditions and regulatory environments. Bank size and type. Research indicates that the impact of capital adequacy on profitability varies by bank size and type. For example, retail versus investment banks, with larger banks often having more resources to manage the trade-off effectively. Capital adequacy and profitability are interconnected and influence each other in various ways. While maintaining adequate capital is crucial for financial stability and regulatory compliance, it also involves costs that can impact profitability. Conversely, profitability supports capital growth and risk management, enhancing capital adequacy. Banks must balance these elements through efficient capital management, strategic planning, and proactive regulatory adaptation to ensure long-term stability and sustainable profitability. Understanding this relationship helps stakeholders, including regulators, investors, and bank management, navigate the banking sector's complexities effectively. Roles of capital adequacy as a risk management tool in the banking sector. Capital adequacy is a fundamental risk management tool in the banking sector, providing financial institutions with resilience against various risks and ensuring the financial system's stability. Here are the critical roles of capital adequacy in risk management. 1. Buffer against losses. Capital adequacy measures banks' financial strength by assessing the adequacy of their capital relative to their risk exposures. It acts as a buffer to absorb unexpected losses from credit defaults, market volatility, operational failures, and other risks. During economic downturns or adverse market conditions, sufficient capital buffers help banks withstand losses without compromising their solvency. 2. Credit risk management. Regulatory frameworks like Basel III stipulate minimum capital requirements based on the risk profile of banks' assets. Risk-weighted assets, RWA, enable banks to assign risk weights to different asset classes to calculate capital requirements proportionate to their credit risk. Adequate capital incentivizes banks to maintain rigorous credit assessment standards and conservative lending practices, reducing the likelihood of loan defaults. 3. Market risk management. Banks engaged in trading activities are exposed to market risk from fluctuations in interest rates, foreign exchange rates, and asset prices. Capital adequacy frameworks require banks to hold capital against their market risk exposures, ensuring they have sufficient funds to cover potential losses. Banks use value at risk (VaR) models and stress testing to assess their exposure to market risk and adjust capital allocations accordingly. 4. Operational risk management. Operational risks arise from internal failures, system malfunctions, fraud, and legal disputes. Adequate capital is necessary to cover potential losses from operational disruptions and ensure continuity of banking services. Banks invest in robust internal controls, technology infrastructure, and cybersecurity measures to mitigate operational risks and preserve capital. 5. Liquidity risk management. Regulatory liquidity requirements complement capital adequacy, capital buffers, by ensuring banks maintain sufficient liquid assets to meet short-term obligations. Capital adequacy supports liquidity risk management by providing a financial cushion during liquidity stress, reducing the need for asset fire sales. 6. Regulatory compliance and stability. Regulatory authorities impose capital adequacy requirements, regulatory standards, to promote financial stability and protect depositors' interests. Systemic stability ensures adequate capitalization, strengthens the banking system's resilience, mitigates systemic risks, and reduces the likelihood of bank failures. Regulatory oversight enables regulatory bodies to monitor banks' capital adequacy ratios to ensure compliance with regulatory standards and intervene to maintain stability. 7. Investor and stakeholder confidence. Transparency and trust are essential for banks to have robust capital adequacy ratios that inspire confidence among investors, depositors, and stakeholders. High capital adequacy signals financial health and risk management competence, enhancing the bank's reputation and access to funding. Case studies. 1. 2008 financial crisis. Role of capital adequacy. Banks with insufficient capital buffers struggled during the crisis, leading to significant losses and requiring government bailouts. Regulatory response. Basel III was introduced post-crisis to strengthen capital requirements and enhance risk management practices. 2. COVID-19 pandemic. Capital resilience. Banks with adequate capital buffers were better positioned to absorb credit losses and support economic recovery efforts. Regulatory flexibility. Regulators temporarily relieved capital requirements to facilitate lending and support liquidity during the crisis. Capital adequacy plays a crucial role as a risk management tool in the banking sector by providing resilience against credit, market, operational, and liquidity risks. It ensures banks maintain financial stability, comply with regulatory standards, and safeguard investor confidence. As financial markets evolve and risks become more complex, maintaining adequate capital buffers remains essential for banks to navigate uncertainties and sustain long-term profitability and resilience. Conclusion. This video discussed banks' capital adequacy and its roles as a risk management tool in the banking sector. Banks' capital adequacy is vital to their overall financial health and stability. It encompasses various components and has far-reaching implications for the banking sector and the broader economy. Ensuring adequate capital levels is essential for maintaining confidence, promoting stability, and supporting sustainable economic growth. The concept of capital adequacy has evolved significantly over the past century, driven by financial crises, regulatory advancements, and the globalization of banking activities. However, maintaining optimal capital adequacy presents numerous challenges for banks. Economic fluctuations, regulatory compliance costs, and the rapid pace of technological advancements all influence a bank's capital strategy. Furthermore, balancing sufficient capital buffers and pursuing growth opportunities remains a delicate issue for bank management and policymakers. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial, please give it a thumbs up and share it with your friends. Thank you for seeing the Solomon Fadun, Risk Management of Everything videos. I love to hear from you. Please post your comments and questions in the comments section below. If you are new here, subscribe to the channel, Solomon Fadun, Risk Management of Everything's channel, and press the notification button to be notified when new videos are uploaded. Thank you.